Good morning, ladies and gentlemen. We are airborne now for one of our final full throttle sessions, and no, you don't have to adjust your screen. You did not, the ice cream man isn't at your front door. As I told many of you last night, today is career day for my daughter Keely. Yes, yesterday was her 9th birthday. With all the balloons above the table here. It's also career day for last year I wore my flight suit, and I brought in my my helmet and stuff, and she asked this year if I could wear my ice cream man suit. So that is what you're looking at. Don't adjust your TV set, and I can't wait for chocolate with sprinkles. Doug, throw that guy out. And I can't wait for what Doug has to say. Comcast. Okay, good. Folks, I'm going to be very, very brief. That's why it's called a brief, because I'm going to get out of the way and let Doug trade for about the next hour and a half to 2 hours, especially before the market opens. But I'm just going to cover some things. The advanced live trade brief, I think, and well, Annie's at the office now. I don't know how many slots we have left. I know a bunch of them went during Doug's session last night. Great job last night, Doug. I even got a couple emails that said, hey, man, this you're not kidding. This guy is a hell of an instructor, and he would have stayed all night had you not come in. And that's Doug. Do not take advantage of Doug, or you and I will have some serious talk. Tomorrow, Doug and I will debrief. Some admin items I'll cover real briefly. The remaining flight schedule, which is this and Doug's advanced trade alert this afternoon, and our weekly options tomorrow. I gave you this, the link to grab your slot already. Somebody already, as we got started this morning, let me tell you who is, as we were sitting here, because I know people sitting here like, yeah, okay, these guys are great actors. Let me unplug that. Jethro from West Bloomfield, Michigan, got a defensive annual slot. So, folks, we're winding down not only to the end of full throttle week, but we're winding down to the end of our slots. And Doug's going to do his advanced live trade brief in a couple of minutes, and also do an advanced trade alert later in the day whenever he finds something good. Here's where we are, folks. We did our welcome aboard Monday night. Tuesday was Wiz Day, the primary live trade brief and the urgent alert I sent out. Goldman Sachs, Apple, VXX we talked about, and Wednesday afternoon, that slide's wrong, we did the accelerated retirement yesterday afternoon at 1. Doug, you met last night for the first time. Hell of an instructor, as you guys saw, with his vertical spread training, and we're doing the advanced live trade brief and his advanced trade alert today. Tomorrow, Doug's going to join me for a quick, I don't know, call it a 20-minute, 30-minute debrief. Any questions for Doug? Hey, Doug, Wednesday night, I have a question, or what Doug covered today, I have a question. I'll clear Doug off, and then we're going to do our weekly options, even if we fill all of our 50 slots, which, based on my phone buzzing right now, there go. I'm not going to, whoever it is, we're going to be done most likely today, folks, or no later than tonight. I'll still do the weekly options brief tomorrow, just because it's on the flight schedule. I showed you how many of our members made at least $1,600 between Monday and Tuesday, or Wednesday if they still held on to the trade, on an S&P 500 bull put spread. We were one of the only, we are the only, because I've done this research, financial training firm, not hedge fund and all that stuff. Jeffrey Gunlock from Double Line Capital predicted what we predicted. The only financial training firm to predict a Trump election, a Trump rally, and after these idiots who missed it said last week and this week, sell the inauguration, it's going to pull back. Futures are up. Yesterday's Rip Your Face Off rally. Again, we predicted that. I don't know where else you need to go. Maybe you're hanging out to see Doug in action today for his live trade brief. We're not going to be around much longer, folks, because we really need to close our doors and get airborne trading. You guys know me by now. Again, this isn't dress up day at Top Gun Options. I'm heading to my daughter's career day, and I got to get out of here in about 5 minutes, and I'll turn it over to Doug. That's me. In my younger days, the uniform still fits, Doug, which is comical to me. But after I went from the cockpit to the trading pit, I essentially ran Peak 6 Investments. At the time, it was a $2.5 billion vol arb firm. And then I was the founder and CEO of the Options News Network. That's me on the floor of the, that's CBOT, where we'd shoot, 3-4 shows a day, kind of the CNBC for options, where I gave retail traders such as yourself a behind-the-scenes look at what was going on, unusual options activity. Hey, somebody came in and bought 50,000, February 1st, Doug Robertson Inc. calls. Good thing to know at the time. So that's what Doug and I do here is try and break it down to the retail trader. Doug and I talked last night about actually how we didn't hate Chicago. We love Chicago. We love Midwest people. We love steaks at Gibson's. Didn't like the people in about a 4-block radius, man. They'd step over their own mother to make a buck. Whoever the guy was last night, he's like, oh, you guys must make more money doing this than you do trading. I make a shit pot of money trading, but Doug and I, as military guys, we also put the ladder down, man. And that's what might be strange to a lot of you, is hey, man, it's time to give something back. The guys and the gals making money on Wall Street, they don't need another house in the Hamptons, okay? Maybe you guys do. So that's why Doug and I do this, okay? So we're going to get airborne. Doug Robertson, you met last night. If you didn't, I'm going to show you the replay page before I turn it over to Doug. His replay from last night is already posted on the page. That's why I sound like I'm tired, is I was up until about 2 in the morning working to get you guys the replay so you can you're not going to watch it while he's talking, but you can watch it later in the day. He's a hell of a guy, runs a small fund down here in South Florida. He was the director of European trading about a block and a half down the street from me, from Jackson and LaSalle, and he's a good dude, as many of you saw last night, as far as instructing. Definitely different demeanor than me. Some of you are like, hey, man, throttle back. I'm like, I will throttle back a little bit, but Doug's going to train you. I'm going to, and in the live trading today, Doug's going to show you what you learned last night. We have training to support the live trading. Doug and I didn't read a book on how to fire a mortar or how to fly a Hornet and then go out and do it. We went out to a simulator or we practiced. So that's what these live sessions are all about. So Doug's going to do that in a little bit. Every Thursday at 9 a.m., this is why we open the door to our squadron. It's because we wanted to get you in the regime of, we're doing our normal flight operations right now. Join us this morning at 9 a.m. because next Thursday at 9 a.m. you're going to be with Doug when you become a member today. He does all the stuff that I do, very market-appropriate tactics. Straddle, strangle, calendar, this, that. You know, when you have a hammer, everything looks like a nail. That's not Doug. He's going to select the appropriate tactic for earnings or whatever it is for the appropriate time. If all you know is how to trade an iron condor, that's all you're going to look for. That's not Doug, man. He's got a full toolkit, as you're going to see here, and I think he's got a couple earnings trades to look at. The guy wants to manage risk, folks. As you saw with me Monday, Tuesday, and half of Wednesday, the first thing that I look at is, how am I going to get killed in this trade, and what's it going to cost me? And if the risk is not good enough, I'm not going to do it, or I'm going to reduce the number of contracts. So you're going to see the same thing with Doug today. 99.9% of you, except our members that are in here, look at a trade and go, all right, how much can I make? That's the last question you should ask yourself before squeezing the trigger is, how many, how much money can I make, or how many bad guys can I kill? How about, how am I going to get killed? And then let's worry about everybody else, okay? So real quick, before I turn it over to Doug, your administrative items for the day. There's where the replays are. Not there. Here's where the replays are. It's FT-replay. Go.topgunoptions.com/FT-replay. So all of you in the chat box right now going, hey, where's last night's recording? It's on this page. There it is. And then for all of you saying, Wiz, I better be one of the 11 people that are getting a slot today or tomorrow. I can't answer that unless you grab a slot today. And we will have a special announcement. Doug will join me, like I said, for about 20 minutes tomorrow. After that, I'll do my weekly options brief, and I'll have a special announcement if we have any slots left. And there's my phone buzzing, and there goes another slot. So, folks, again, Doug and I, Steve Trafton from Memphis, Tennessee. Sweet. Welcome, and that's a full throttle max. So there's 10 slots left. Here is the page where you get your slots. The offensive track is everything plus weekly options. The defensive track is everything plus accelerated retirement, and then obviously max afterburner is everything we do here, including accelerated retirement and weekly options. Somebody asked last night, Doug, if these are the monthly prices. Yes. No, they're not. These are annual prices, folks. I wish they were monthly, or they should be monthly based on our performance. I personally, as you guys have seen live or you've seen in the replays, I've closed over $5,000 in trades this week. One was an Apple Iron Condor that I legged into last week. Sorry you weren't here, but I at least showed you that I closed it for my members. So $5,000 at least out of me this week, and that would have paid it for a max afterburner slot for a year in about 3 days. It's Thursday. In 3.5 days, you would have had a max afterburner slot with my members. I showed you all the Goldman Sachs, I'm not going to say winnings, profits from current members, and I took screenshots of those. Those aren't Doug and I photoshopping returns and saying, hey, look at what Diane made. Next week, when you join, you will be in Go to Training, and you'll be able to chat in between each other. Go to Training holds up to 2, 3, whatever it is, 500 people. This one, the Go to webinar, only holds up to, or it held up to 500, and then Doug had to call Citrix or whoever it was the other day and up us to 1,000 people, because I don't think you guys saw the warning. I think it's only for the instructor, but I kept getting a warning that said, warning, you've reached your room limit. It didn't say throw out. It said, remove people to make room for more. I couldn't. Here's how many people have been with us this week, 3,875. Even if you don't join TGO, there's got to be a better financial training firm out there. Next time you go to one of these online webinars, go, hey, Steve, can you show me how many people registered for this event, and see if they show you. Full throttle training week, nearly 4,000 people. Okay, so, all right, Doug, if I get done right now, I have time to hit Starbucks and then go to my daughter's class. So, guys, I'm going to leave you in good hands. Again, let me give you a quick disclaimer. Wearing this is not a Department of Defense, support of Top Gun options and quack. You know what? Actually, Obama's not in charge, so F him. It's still not a DOD endorsement. It's my daughter's career day. I got to run. I wore my flight suit last year, but this year she asked me to wear my ice cream suit. I'll be back in about an hour. And then I'm going to watch Doug do some of those live trades. So, Doug, my friend, I'm going to give it to you. You guys have a great time. I'll be back in an hour. As Doug's talking, folks, people will literally be grabbing their slots. So please, if at the end of this, Doug, we have 10 more people go, it's over, man. You can keep talking, but we're going to get airborne Monday without him. Okay? All right, my friend, over to you.
All right. Well, good morning, everybody. Second here, just getting my screen all set up. So, how's everybody doing today? Let's see. So the Dutch regulators accidentally posted Soros's short positions. Oops, that kind of stinks. I know, Doug on camera. This is different. So yes, here. Hello, everybody. This is what I look like. For those of you who might be showing up first time, this is actually extremely rare. Most people don't know I'm normally sitting here in flip-flops, shorts, and a t-shirt and don't have the camera on, because I got out of working in formal clothes a hell of a long time ago, and I don't want to go back. So so this is me. Hey Harry, hey Mark, Rob, everybody. Okay, we have some work to do today, so apologize if I move along quick, but we've actually got quite a bit of stuff to handle. We have a Comcast trade that at this point, things are moving around fairly quick, but it looks like we're going to walk away from with some money in our pocket. Knock on wood. Our biggest enemy in this situation is going to be volatility dropping a little bit more than expected. Let's see, knocking out some big picture stuff. Let me just give you a quick little rundown of what we normally do on an ALTV class like this. I'm modifying it slightly just because we've got a lot of stuff and we have a lot of people here today. Normally we take a bit of time, go over what's the big picture out there, what's happening in the markets, what's going on in the world, what's going to be affecting our trades. And it's a heads up. Situational awareness is critical. You need to know what's going on in the world and what's going on in the markets so that you can be smart about what you're doing with your trades. It happens to be Thursday morning, so usually we're taking a quick look at jobless numbers and a big picture about what's happening out there. Quick little rundown. Jobless numbers jumped 22,000 up to 259,000 new applications. It's a decent little jump, but honestly, those are still amazing numbers, so not a big deal. Number one thing that we've got to seek economically is we really need to have money moving into middle income jobs. Got to get that. If we don't get that, then we are rapidly moving into a demand side crisis. you can talk all you want about making sure the companies have money to expand and grow. Well, guess what? The last 5 years, money has been basically falling off of trees into companies' hands. They've been able to take loans out at rates that are absolutely historically astronomically low. They've got more cash in the bank than they have ever had in their lives. Historically, we've got more cash in companies than you have ever seen. Take a look at the book values across the board. And guess what? They haven't invested a damn cent in it. They haven't grown. They haven't, hired new people. They haven't expanded markets. They have done crap with it. You know what they've done? It's turned around and put it into stock buybacks. You know what a stock buyback does for you, me, and everybody else? Not a damn thing. You know what it does for the CEO and the president? Boost the stock price a little bit so that they get their bonuses and they make more money. So, why haven't they been growing? Because they haven't had people buying stuff. We need money in people's hands to buy stuff. Big driver there. So trying to put more money in the top is not going to help. We need more money in the middle. Really want to see something come out of this whole new administration in that direction. A couple other notes that we've got floating around. We've got, obviously, big picture item. We have the Fed. What's going to happen with interest rates, things like that. We're on pause at this point. We had an interest rate increase. We are unlikely to see an interest rate increase until, at least as far as everybody's concerned, June at the earliest. Looks like right now we've still got about a 72% chance that we're going to be going up to 100 basis points in June. A little bump on that one. That's from the 75 basis point target that we're at right now. If that happens, borrowing costs go up a little bit, but there's an interesting side effect of that. Just so that you know, that's not, interest rates going up are not automatically a horrible thing, because what we've got is that's creating an incentive for the banks to actually start using some money that's been sitting there. And we actually have this ghost $2 trillion stimulus package that nobody ever pays attention to and doesn't know about sitting in the banks. It's called the excess reserve accounts, and it is right there. Ever since 2008, the Fed has been paying the banks large amounts of cash to take their treasuries, mortgage-backed securities, everything off the books. That cash has been sitting in what's called an excess reserve account. This is the money above and beyond what the bank has to keep in cash to actually be a bank. Now, so what does this mean? Well, normally, before 2008, that money would have been loaned out and it would have hit the economy, and people would have used it to buy houses, buy cars, invest in their business, grow whatever the heck is happening in the economy. Well, didn't happen, because at the same time Congress came along and said you were going to give out an interest rate on this that is going to compensate the banks for holding on to this money. Right now that interest rate is 0.75% per year. May not sound like much, but when you're getting paid 0.75% to hold on and not use $2 trillion worth of money, that's a ton of money in your pocket. Remember, a bank normally, when they're doing their operations, has to have tellers, has to have bank locations, bank managers, loan officers, do due diligence, all of these things, they all cost money. This money basically puts cash in their pockets for free and doesn't cost them anything. 7 or 8, 9 people in a small office managing $800 billion worth of money just sitting there, which is specifically not doing anything. As interest rates go up, there's more and more push and more incentive to use that in the market and loan it out. You'll see that we've already had that start to drop. It was actually up almost $2.7 trillion. As this number goes down, more money hits the economy. Like I said, hidden stimulus package out there. Second thing is, this money, the interest rate on this just jumped up, and that's going to mean more money in the bank's pockets too. Once again, free, risk-free profits for the banks. Not a bad job. In fact, I think I'm going to quit this and I'm going to become a bank and just take some money. So, good little thing to know out there. Quick little other thing to be paying attention to. For those of you who are new here, let me hand you something. VXCentral.com. This is one of my radars. I believe very strongly in a few things. Number one, don't listen to what most people tell you. I love it when I hear people say, oh, I was watching CNBC and they told me that this was going to happen. You know, I know the people who go on CNBC. Many of them are friends of mine. Respect them, think they're great people, but I'll tell you something. CNBC does not make their money from making you money. They make their money from getting you to pay attention and watch their advertisements. That is how they make their money. The best way to do that is have this nice little list. It says whenever this happens, call this person on this side and this person on this side, because they're the two people who are most likely to disagree on the answer. Doesn't mean they're going to give the best answer. It means they're going to disagree on it. You know, and having somebody jump up and down on stage and ring a cowbell does not make them the best source of advice. So never trust anybody saying anything. And I'm going to even raise my hand and include myself in this. I've got my own biases, I got my own ideas, I got my own thoughts. Don't even necessarily control those terribly well. What I do trust is when people put their money down. Now, what we're looking at here is a measurement of the futures prices on the VIX. VIX is a measurement of volatility, risk, and I am seeing what is the market pricing up for the VIX in the future. And right now, the VIX is trading, the futures contract is trading at a fairly serious premium over the VIX. So the futures contract that expires in 19 days is trading at 1275. Currently, VIX is down around 1071. What does this mean? It means that a bunch of futures traders believe that there's a decent chance over the 19 days that the VIX is going to bump up and make that 1275 purchase worth it for them, because that would actually increase as the VIX goes up. Over time, they're pricing in a lot of extra volatility and risk. It's reasonable, and you'll almost always see this. It's the slope and the, you know, how deep this gets. By the way, this is called a contango situation, where the short-term futures contracts are less expensive than the long-term. This is going to affect one of the trades that we're going to do today. It's a VXX hedge. We'll dive into that. But right now, honestly, this is not crazy right now. I've seen a much steeper slope, and I've seen a much kind of crazier number out here. So I'm not extrapolating too much into this, but we do have a lot of risk priced into the market. People are paying attention. Now, let me see. Talked about FOMC, talked about that stuff. All right. I'm going to do a super quick covering of a couple of trades we've got out there. Richard, if you did not get into Comcast, would you suggest entering? No, absolutely not. That trade is done. All right? That trade, as a matter of fact, the only thing that we've got left on that is picking up our money. I will be looking at that in just a second. Now, to do that trade, you would have had to have been in that trade yesterday before 4 o'clock. Now, if you missed on it, don't feel too bad. There's plenty of these coming along. We're right in the center of earnings season. We've got a lot of stuff happening. In fact, knock on wood, and I can't promise this because, you know, please understand something. The trades that I do are based on what's happening in the market right then. So I have two targets, Google and VMware, that we have the possibility of putting a brand new earnings trade on today. We're going to analyze that, we're going to sort it out, and we're going to basically lay out how we're going to do our trade. I have an alternative that may work, which is Northrop Grumman. Now, I said I've got two targets. That means I did not, you know, it doesn't mean I hit them. I need to do a little bit of work and figure out whether or not they're good trades, and we're going to do that. So you're going to see the process step by step as we go. I'm also going to be doing a VXX hedge, which we actually really need to get into our portfolio, and I'm going to be looking at, we explored Nike a little bit last night in the vertical spreads session, and I'm going to explore that as actually a trade for ALTB this morning. So take a look at that. All they care about is commissions. Actually, CNBC doesn't make commissions, but they make a ton of money off of advertising. And the more somebody jumps up and down on stage and rings a cowbell, the more antsy I get. So, I don't know. I just, the crazy stuff, I'd rather dig into something and actually understand what's going on better. than do a bunch of antics. I suppose I could put a cowbell in here if you really, really want me to, but it's not my thing, sorry. Rick, you probably should have an aversion to that. When I see that cowbell, and by the way, just to give you a little bit of extra information, you can maybe determine that I am an absolute, completely antisocial, anti-society person from this if you want, but I gave up TV about 7, 8 years ago. I literally do not own a TV. There is no TV in my house at all. So I do not watch CNBC. I do not watch any of those shows, period. When I want to understand something, I go out and I dig into the data and I see if I can figure it out. You know? So maybe I'm a little biased and it's probably old views, but I'd rather be a little less swayed one way or another and actually look at what's going on. Expand my horizons with TV? Oh my God. TV doesn't expand your horizons. It narrows them. It makes you focus on one little box and think that that's the font of information that is the source of all knowledge, which is completely not true. All right, let's take a look at a couple of things that we got to deal with before the market opens. Quick little maintenance things for everybody who's in my ALTB, regular customers. By the way, thank you guys. Appreciate you being here. You realize that every once in a while we do have to do promotions, and I know this is a little bit crazy here, but next week we'll be right back in the normal schedule doing our normal thing, and hopefully we'll have some new members with us. Actually, not hopefully, we do have new members with us, so looking forward to that. Couple of maintenance notes. Whole Foods. We are closing that trade today. We're going to be taking our profit in that. Now, question is, how much of a profit do we get? This was a pre-earnings trade that is wrapped around the Whole Foods earnings announcement, which is coming up on the 8th. Everything's going great on that trade. A big question is, I've had an order out there at 125 as a profit target. I don't think we're going to quite hit that, but that was a fairly aggressive target. There's a chance that we might get a little bump on the open, but we have that trade closing out today. Quick little look at that, and we are in a pretty decent spot. I'd love to see Whole Foods move up just a little bit, but everything worked out great. It did what it's supposed to do. We're going to take our money. So partway through the class today, we're going to be kicking off a trade to close that out. So that's good. Flip side of that, Priceline has been aggravating, but we are not done. So Priceline is another pre-earnings trade. For those of you who are new here, we do a lot of different trades around events, earnings, volatility, things like that. There's two different ways you can do it. One is you're riding the implied volatility up into the earnings announcement, because as soon as the earnings announcement approaches, the implied volatility gets higher and higher and higher and higher. We can set up trades around that, and we can set up trades around that to capture that increase in implied volatility. And then we close out the trade even before the earnings announcement happens. And then, like we have with Comcast, we have an earnings announcement trade which captures the implied volatility going down, basically the collapse after the earnings announcement. And that's what we're going to be doing in just a few moments. Now, the Priceline is a pre-earnings trade. This is not finishing till next Friday. Now, we've had some really strange stuff going on volatility-wise in the market. I don't know whether it's anxiety around the inauguration, whether it's just overall weirdness. Here's my take right now. The market has been in a very overly optimistic state. In fact, it's got me a bit worried. I guess when things get too good, I get nervous. Anyhow, implied volatility on Priceline has not come into the trade quite the way we wanted it. We're still waiting for a few things to happen. The trade is perfectly fine. I know that we're underwater a little bit on it, but I'm not changing it at this point. And there we go, Comcast. Let's take a look at where we stand on this thing. All right. Now, Comcast, let's take a look where we are. I'm going to clear some things out. All right, Comcast is opening at 73.75. Now, excuse this jumping around like this. Gotta clean out some of this. Okay. All right, we're in a small profit right now. This is what's going on Comcast. Two things. We have the implied volatility in the value of our short options, which are the 72 put and 75 call that expire on Friday. Those are going down. They're heading down towards zero, degrading very, very fast at this point. We're being protected by the 72 and 72 put, 75 call that is long. Now, there's two ways. Let's walk through the ways that this wins and loses. Now, the biggest enemy to our trade right now is implied volatility dropping too much on the 72 by 75. Right at this moment, we are in the middle of the whole thing. Market is sorting itself out, trying to figure out what pricing level it's going to be at. A lot of different things going on here. The pricing, okay, we're up around 90 cents. I'm shooting for $1.18. I'm going to be a little patient as the market sorts itself out. We are currently in a moderate profit, a little, actually slightly disappointing profit, but this is going up. Hey, here we go. Nothing like making 1,200, 1,400. Yes, yes, yes. Okay. I am going to close this current order out. My $1.18 target was probably a bit aggressive, and given the fact that probably a decent chance we're not going to hit exactly there, but all right. Now, a couple of things. Market is moving around a lot right now. It's very chaotic. There's wide spreads. The market is trying to sort itself out. We want to try to find a spot that is pretty decent, where we're going to be able to have a good chance of getting our fill and walk away from this. I'm going to shoot for about $1.13 right now. Monitor that. As I said, this is going to be jumping around a bit. A lot of things are going on. People are trying to figure out what did the news that Comcast just had mean for the market. What did it mean for the stock? They're absorbing it. And remember, they only got this just a short while ago. So, and a lot of people who are just coming into the market are just trying to absorb it and figure out what's going on. Our best bet right now, the greatest thing that could happen to us is if Comcast starts to move up towards roughly towards the 75. We don't want it to go too far, but we want it would be nice to head over here. We're in a good solid profit right now. Things are going to tighten up as far as the bid-ask spreads. We're going to have easier times getting fills. I like to leave a fairly aggressive order in the market when we open for the open of the market, because there's a chance, not necessarily high likelihood, but chance that the chaos actually fills us and we walk away with some money in our pockets. We're in good shape right now. I would like to make a little bit more money, but let's not complain. Let's see. So, as I said, things are jumping around. Right now, I'm just putting, actually here, I'm going to drop this down to about 110. I don't want to be overly greedy. And let's see if in the next few minutes we get a chance to get a fill on that. A lot of times in the first 15, 20 minutes, you know, we've got this opportunity to maybe get a little bit better price. If things don't fill by the next, I don't know, let's say 15 minutes or so, I'm going to reassess everything and most likely just take whatever profit I've got in the market. We're doing okay right now. You know, overnight we've got at the moment $1,200. If we hit 110, we'll be hitting what, $1,500–1,600. That would be probably close to a 25% return overnight. So the trade itself, at least in concept, let's get it closed, is working. And I'll show you how we did that in just a second. Yeah, going, come on. Come on. Man, such a tease sometimes. Let's see, questions. Yeah, Enfuego, PCL earnings date still not confirmed. It's going to be later, which is fine for us, as long as it's between our dates, and there is a risk in that. So kind of on that trade, I do understand the risk. I know it's there. I would love to see PCL confirm, but we'll see. John found that it was easier getting out by individual calendars. It might be, to be honest with you, I found that if you do, a put calendar and a call calendar to get out, what happens to me a lot is I'll get filled on one side and I end up chasing the other side and I end up losing a lot of my advantage just because of slippage. It's a personal choice. You certainly can get, the smaller, more focused the trade, usually the easier the fill. There's a little advantage there. Flip side is you end up chasing sometimes and get some slippage. Gee, why not scale out of the Comcast position? Because it's a lot of work, and I've never found that really gets me a huge amount of extra advantage, and plus, if I have per ticket costs, I'm ramping up my cost. You can do that, certainly. I try to keep things a bit simpler, more focused. I'm not saying you shouldn't. Everybody can have their own little fine-tuning refinements on every trade and strategies to get in and out, no problem. But in this class, I tend to do one order and get in and get out nice and clean. Do I advise trading first thing or waiting for your place to place my orders? Well, I don't advise either. I advise trying to create the best opportunity for yourself to make money. If you are exiting a trade and trying to target a decent profit on something, leaving an order in through the chaos of the open, an order that if you get filled is a good, solid, profitable order, great. Use the market chaos in the first few minutes to your advantage. If you don't get filled, you work the order. Would I enter a trade at that point? Let me say this. I probably wouldn't analyze a trade for an entry at that point because the data you're getting in the first 15, 20 minutes of the market's chaos. You get people jumping all around, the market is filling in. You really don't have a clear picture of what's happening. So analyzing a trade at that moment is a little tough. If I had a trade that I wanted and I knew the price that I was comfortable getting filled at, absolutely I would put an order out and see if I get a fill. If I do, the hand of fate just gave me a good trade. If I don't, okay, I have to go to work. Not a big deal. I don't hate the first 10 or 15 minutes, but I treat it with respect. Know what it is and use it for what it's good for, to get you a maybe lucky little extra advantage. Don't treat it like the time when you're going to get a perfect fill. Do I ascribe to the adage, amateur traders trade the open, pros trade the close? Well, I'd switch that around. Pros know how to use the market to get an edge, and they know when they can get certain types of edges, and they use that to get the better fills and to get the better opportunities. Now, that can happen at the open in certain situations, and it can happen at the close in certain situations. The close is nice because people, in a lot of cases, are being forced to do things. There's a lot of people who have to level out positions by the end of the day, and they've got this anxiousness, and they sometimes do trades that, if you're on the right side, can push things in your favor. Close is a great time. Open is chaos. If you can take care of chaos, then if you can take advantage of chaos, absolutely use it. I wouldn't shy away from it, but don't expect that you are going to get, number one, clean information or clean fills in the first few minutes. Just don't expect that. If you can get something that's good for you, take it. So that's my thing. I don't like, and most people find this after they've been in with me for a little while, I do not like hard and fast rules that tell you to stop thinking and just do what I tell you. Hate those. Because basically what that means to me is, your job as a trader is to think. You get paid to think. You get paid to analyze opportunities, analyze risks, figure out the best opportunity for the least risk, most control, and that's how you make your money. If I tell you a hard and fast rule that says always do this, what I'm telling you to do is stop thinking. And that is not smart. Now, I will give you information about what is what to look at so you make a better decision, but I do not want you to stop thinking. All right. Can I please tell you how to apply for a Thinkorswim trading account? Actually, Thinkorswim would probably be a much better place to get that information. I do not have a relationship with Thinkorswim. I would just go to thinkorswim.com and click the button that says apply for account. I've done it before. It's quite simple. Do I use support and resistance? Yes, but you also have to realize that support and resistance are what I would call ephemeral light effects. Support and resistance are wonderful things to use when the market is drifting along and doesn't have any kind of major drivers in it. Support and resistance will get blown straight through if there's anything that is pushing the market in a specific way. So yes, do I use those? Absolutely. Do I trust them on every trade as my gospel isn't gonna, is not going to go past this point? Heck no. Do I use other technical things? Very, very rarely. So there we go on that. All right, we are settling in right now. It is 9:41. I'm going to give it a couple more minutes on this Comcast trade. We're in a very good spot. Let me show you a few little things on the analysis page about what we can know about this trade right now. We have two lines up on this analysis screen. One is the purple line, which is the intermediate P&L, and that is effectively what is the P&L now, or, well, through a kind of weird top Thinkorswim calculation, what is the P&L? There we go, a little bit better. What is the P&L now? The blue line is if the options stay at this implied volatility, and that's a very important thing to consider, if the options stay at this volatility, what will the P&L be at the expiration of the first options? Those are tomorrow afternoon at 4 o'clock. I have a profit in this trade right now, and honestly, I have a good profit in the trade. So do I want to risk it by holding on and maybe having the stock price go up or maybe down? Or do I want to take my profit now and walk away? Honestly, money in hand is a good thing. The old adage, you don't go broke by taking profits. Not 100% true, but it certainly holds a lot of weight here. So my expectation is in the next couple of minutes, I'm going to close this trade, walk away with my money. I mean, this was literally overnight. Now what's going on? Okay, jumping around. What's happening here? See, this is what I don't want to get caught in, suddenly having the market going against me. So I am going to shift this down to a little bit more aggressive exit. Take a little less profit, still a nice profit. I'm going to go for 103. You see here, Bill, you got filled at 103. Well, let's see if I can match you. All right, now I'm just waiting for the market to do its thing. All right, what just happened? Comcast jumped way up. See, this is the balance of risks. If Comcast moves really quick, it can go past our kind of peak point, and we can be in a point where we're not making as much money. It stresses you out, makes you feel like you've got to jump, gives you a little anxiety. Now, Bill closed out at 103, and that was probably a smart move. I am going to try to close out at 103 also. If this just drops down a little closer to 75, we've got a decent chance of doing that. Come on, I am touching it right now. See, this is the fun part. Okay, come on. And the mark, the midpoint is past that. I just need my fill. Give me my fill. All right, there's a good chance that's going to fill. So we'll just wait for the beep and go from there. Let's see, what do we have? Keith, I didn't get filled on the Comcast trade until late yesterday. I was trying to get filled on a whole series of earnings trades, and yay, we just got filled. So I sent you the information as soon as I was able to get filled. I do a couple of things. I send out lists of targets for people to work with. This is the same list of targets that I have. If you learn the trade, learn the ideas, you can identify these things yourself. If you're waiting for me, I will give you the information as fast as I possibly can, which is actually what I've got to do right now. Hold on one moment. But I have limits, just practical limits on how quickly things actually happen sometimes. So let me see. We just got filled. Okay. I will promise you I will do my best to get that information in front of you. But just understand that I live in reality, and it's sometimes hard to push reality too fast. All right, let me just do something real quick. Okay. Hey, one of my guys, do you have the fill that we got on the entry yesterday? I just don't have it right in front of me. So if somebody could just toss up that entry price that I sent out, I'd appreciate that. William, do I send out alerts by text or by email? All right, this is the way it works. What I'm about to do right now is send out an alert by text. That has the basic information, the structure of the trade, all the contracts, the basic details, so that you can get it fast. And I follow up after the session is done. 85, thank you very much. After the session is done, I follow up with a full, I think a fairly decent breakdown of everything going in on that trade. Why are we doing it? What's the current conditions in the market? How is the trade going to work? What is the reason for the trade? What is the core idea behind the trade? How is this trade going to make us money? What are the legs? Breaking it down. What is our risk management? And how are we going to capture our profit? We break that all down into a full detailed trade report. By the way, all of those are on the site, archived as posts, and that goes out as an email. That fills in all of the details of how and why I did all of the things about the trades. Now, if we're doing a trade live in class, like we're doing right now, let's see, divided by 85 cents. All right, a little disappointing, but we made 20% between yesterday afternoon and this morning. Would have liked to have made more, but I'll take it. If we do it live in class, you get all the details of it in class, just like we're doing right now. If it's not live, I do send out extra alerts and trades outside of the class in the ALTB. I will give you everything that you want to know about the trade. Plus, if you have questions, you can always hop on the ready room and ask. All right, so sending this off. And I've probably talked too much. I should have sent it off a few minutes ago. Those of you who are on our system and customers, you should be getting a text message right about now. And there we go. Okay, so let's get into the other stuff we've got to deal with today. Don, today we've got a very large group. By the way, Don's a longtime member. Love to see him. Thank you for being here with us today. What we've got is GoToWebinar, and the reason for that is we've got a huge crowd. In fact, let me see how many people. Yeah, we're up to around, a lot of people, 400 or so in here at the moment. And to handle that, we have to use GoToWebinar, which bluntly I don't like because it stinks, and next week we'll be right back to GoToTraining, which is a much better platform for us. Okay, let's see here. Excellent. You guys got the text. Good. The percentage return on that, Silvana, was 20% between yesterday at about 3:30-ish to this morning at 9:50. So grand total of, let's see, 30 minutes, 20 minutes, 50 minutes market time, 20% return. I'll take that. Okay, moving on. How about taking a look at a potential new version of this? Anybody interested? So let's walk through. What did we just do? We had Comcast. They had an earnings announcement this morning at, what time was it? I don't know, 7 o'clock, something like that. And that earnings announcement to the options market meant risk, meant lots and lots and lots of risk. So what does risk mean? It means it increases the price of options. When risk goes away, options prices or the value of the options will drop because there's no risk anymore. We don't have any uncertainty. We don't have any fear. We don't have any doubt about what's going to happen. We know what's going to happen now. We know because it just happened. We got all the information. So what we did was we created a trade which used very high implied volatility on the options that expire immediately after the earnings announcement. We shorted those, basically created a short volatility trade on that leg, and then we went out on about 3, maybe 4 weeks into the future, found kind of a sweet spot, and we wanted to protect ourselves using long options. Now we can't just do short options on this, because a naked short position has a ton of problems. Massive level of risk, huge margin, terrible return on investment, and just overall god-awful bad idea. But by converting a short naked strangle into a dual calendar style structure, we can play the difference in implied volatility between the short-term options and long-term options. Now we still have a trade that has to land within a range. But what's happening here is the options traders are pricing in what they believe is all of the risks around a crazy earnings announcement. And then on top of that, they're padding that risk with a bunch of profit. Well, we're jumping right in on the same thing with them and using their, essentially overpricing the market. And by the way, as they come into an earnings announcement, the sellers of options have an amazing amount of pricing power. They have a lot of control because there's a lot of people out there who really desperately need to get a fill. And they're not picky about price. They just need to make sure that their hedge fund doesn't lose their shirt by basically irritating their customers by having a big loss. And you want to know a deep, dark secret about hedge funds? You know that 2 and 20% figure that they give for how they make money? 2% asset fee, 20% of the profits. You want to know which number they make the most of their money out of? It's the 2%. It's not the 20%. They make a huge amount of money off the 2%. The 20% is icing on the cake. So what that does is it skews their attitude towards, I'm going to be safe so that I don't lose clients, versus I'm going to be aggressive so I make my clients a lot of money. It's better for them financially, and that's where the options come in. They buy the options to basically protect themselves. So we're going to use that. So we're going to try to find the same exact situation on other things right now. And I have, let's see here. Rick, I'll go through that whole process in just a second. I'm actually going to take this step by step, and you'll see the whole thing. And this is how we do it. This is actually normal. This is what we do each of these sessions. You know, let me be straight, and Wiz jokes about this. It's good and bad. I am, I guess, what you would call detail-oriented. I like to dig into exactly what is going on, why is it happening, and really dig into the trade, which means that I am not necessarily the fastest. A lot of people appreciate the fact that we record these and post up the replays because they don't necessarily last the 2.5 hours, 3 hours that I sit here talking. But I want to make sure that everybody knows what's going on. Also answer a lot of questions, and when I've got a big group, that can be very challenging. So let's dive into the details of what we're looking at. All right, next up on my target list, Google. Let me double check something here. Yes, Google. Whether or not you use Goog or Google doesn't actually matter too much. We might poke around with both. They're effectively the same thing for this trade. Google has their earnings announcement tonight after the market closes. So, as I said before, earnings announcements equate to very, very large risks. What's going to happen? Is Google going to do a massive gap up or down? Is Google going to come in line? Is it going to be boring? Who knows? But it definitely means risk for the options traders. So let's take a look at the book. And yes, this is me. For those of you who've been with me for a long time, if you ever hear me drinking water in the background while I'm talking, this is my great little cup that my daughter got for me, so I can actually show that off now. All right, so let's take a look at this. Google, implied volatility. Options that expire tomorrow afternoon are trading with an implied volatility of 65%. In fact, it's probably, might even be a little different at the money, but an average implied volatility of 65%. Just like I said, there's a lot of risk, and therefore option sellers are pricing things up to basically cover their butts and to make some money. As you go out in the future, we go a week out. This is the February 3rd expiration. 65% implied volatility drops to 35%, down to 28%, down to 25, down to 23, down to 21, all the way down to 16. And by the way, a lot of you have heard this before. I have a love-hate relationship with Thinkorswim. I love the platform because of awesome, great tools it gives me. I hate it because, God, they're annoying with their little quirks and funky things in the system sometimes. Don't always 100% trust this number. Take a look at the implied volatility on the actual options. If I see something going from 22% to 16%, yeah, and that little thing popping up annoys me, to 16%, then back up to 21%, I'm guessing that there might be some weirdness going on in this number. Always double check. So what I want to do is I want to create a trade that is shorting the volatility here, that's going to collapse in a significant way after the earnings announcement happens, and protect myself on that short by using something out here in the future as a set of long options to basically protect my trade and control the risk of my trade. And actually, by picking these, I get a couple of different nice features, and we'll walk through that. So let's figure this out step by step. First thing we need to do is figure out the strikes we're working from. I've generally found that working at about a 1 standard deviation point gets you kind of a sweet spot on these trades. Going narrower means that you're being more aggressive and you're going to position yourself for a higher return on investment, if you're right. It also means that the trade is going to work over a narrower range, and if you have a larger gap, you expose yourself to more risk of a failure. Going wider typically means that you've got a wider range that it's going to make money. It's going to make money if it's going to focus the profits more on if the stock moves up towards our strikes or down towards our strikes, and it's going to have a greater chance of losing money in the middle. We want to find a balance between these two. We want to find a good solid range that the trade works, and we want to find a good possibility for profits. Now, Comcast wasn't too bad. Actually, honestly, 20% was probably one of the smaller wins that we've had on those. Had a couple of others recently. We had Schlumberger, we had IBM. Those two were a little, when implied volatility gets strange, sometimes the trades can get a bit strange. Those two kind of netted out flat. We took a small loss on one. We took a little bit of a win on the other. I think we came out a bit ahead on those two. Let's see if we can pick up the stats this quarter. Last quarter we knocked them home. We were hitting trade after trade. So how do I figure out my strikes? Luckily, Thinkorswim actually gives me a number that actually helps me. This is what's called market maker move number. And if you don't know what this is, it's basically taking the implied volatility, which is an aggregated averaged implied volatility across all of the options, or a big chunk of the options in the options chain. Uses that number to figure out what is an implied 1 standard deviation move between now and the expiration of the options. So basically, 66% implied volatility on these options. Let's see how true that is. It's actually pretty darn close this time. Good for them. I have to send the thank you note to the programmers. 66% implied volatility implies that there is a 68.2% chance that Google, and this is based on the pricing of the options, is going to be within $33.24 above the current price and $33.24 below the current price as of tomorrow afternoon at 4 o'clock. That's the expiration. So that is what this is saying. Now, I use this to basically identify where my strikes are. I tend to go just slightly on the inside of this. It tends to improve the trade a bit, increase your profitability. And you need to also realize, always, anytime you're looking at implied volatility or pricing of options, these are overpriced right now. The sellers of the options are using their pricing power to gain an advantage and get profits. So even if this says 66 and this says 33, what they really believe is less than this. They never underprice it in these situations. Now, there are moments when you can get underpriced implied volatility. They're few and far between. Basically because if options market makers, floor brokers, professional traders did that on a regular basis, they wouldn't be here. So I'm going to go with about 30 bucks. Right now the price is $8.55, which means that I'd be looking at a strike of about $8.25. I'm going to go short on the $8.25. That's an $8.25 put. Add 30 bucks to $8.55. It gets me up around $8.85. I'm going to go short on that. Between those two, I net myself a credit of $11.50. Quick little look at this. Now, a couple of things to note about this. We've got a fairly decent range where the trade could work. Good, not great. These are my break-evens as of this moment. I can make a decent amount, but notice these lines that go down continuously and do not even start to level out. That is an unlimited risk trade. Brokers hate that. Absolutely 100% hate it. And they're going to charge you an outrageous amount of margin on this trade. So we need to fix that problem. We need to make the risks go away, and we need to improve the trade, and we need to reduce our costs. So let's do this. I'm going to go to the book again, and I need to find a little bit of a sweet spot on this trade. Now, I'm looking for a point. I'd like to find a set of options that is as close to me as physically possible, time-wise, but has the least amount of implied volatility drop. Now, visually, I'm just going to go through the book at this point. I don't want to really get too far out. I might, let's see, it looks like about 30 days out. Looks pretty good. We're down to about 23.65% implied volatility. And let's see what this looks like at the actual, there we go. That is not bad. We're down around 22, 23%. All right, so I'm going to start working here. Here's the thing. The further in the future I go within my protective options, the more expensive it is, the more I reduce the return on investment on my trade. The less responsive those options are, and it tends to basically be a little less protection than I'd like. I have a built-in advantage to using options that expire closer to right now, but the protection is going to cost us money. It costs us money because we are going to lose a small amount of implied volatility on these, and the long options are going to go down in price. If I lose more money from the long options dropping in value than I get from the credit of the trade just doesn't work. I'm underwater. I'm not going to make the trade work at all. So we need to test that out. So 825 long and 885 long. After all the expenses, it turns into a $10 debit, which isn't bad. Let's see. Okay, answering a question here from Michael. Concerned about PCLN, am I still comfortable with PCLN? Michael, this is what it comes down to right now. We have not gotten a confirmation on the earnings date on PCLN, and therefore the implied volatility on that pre-earnings trade hasn't shifted into the trade. Right now we're underwater on that trade. When the date is confirmed, we should see that issue resolved. There is a, I would say, growing risk that the earnings announcement is going to get pushed off till after our long options. We actually padded that a little bit, and I'm very glad we did. So I think we're still pretty good. If you're not going to be around, you may want to consider closing that trade. At this point, I'm keeping it on. I believe that it's still in good shape. But you know, we do have a greater risk as we go on that PCLN is going to push their earnings announcement out a week. Or a couple of weeks, and maybe go outside of our range. So just consider that. By the way, that was on a trade that we've had going on. So getting back to Google. All right, Pablo, you're saying you can't see me. There should be a little button that has a camera next to it, I think. I'm not familiar with, I don't use this very often, so that should pop up a little thing with my ugly mug. Honestly, for your own sake, don't press it. Okay, let's take a look at this trade and figure out if it's a good trade right now. So far, everything is going together pretty well. And a couple of things that I like. Let me point out a few positive indications in this trade right now. The implied volatility of the short-term options is very high and more than twice as much as the longer-term implied volatilities. That right there is a very good thing for us. It means that we have a very, very high amount of value being pumped into the short-term options, and that's what we're capturing. We're trying to grab that over this situation. Now, in a second, I'm going to take a look at one other thing that's absolutely critical to this trade. We need to figure out how much this implied volatility in the longs are going to drop. But in general, this right here is good. When I set the trade up right here, you notice I paid attention. I got an $11 and, I don't know, 30, 40 cents in credit. That credit was in total greater than the debit. Now, that means that I got more than half the cost of the debit in credit. That's pretty good. That also looks solid for me. I don't know if the trade's going to work. We've got to figure that out. So let me clear out some other stuff here. All right, here is the trade analysis. Right off the bat, if I could get what I'm seeing on this screen, I would love it. This would be a gorgeous trade. You know, it would be having about $10,000 in risk, with a max profit potential up in the $15,000, $16,000 range. That would be great. Glorious trade. I would take that in a heartbeat. Reality, it's not true. We need to figure out what reality is. Reality is that this trade is going to get hurt. Remember, this P&L you're looking at on the screen right now is based on Thinkorswim not having a clue about where implied volatility is going to go. We can, though. So we need to see where these two long options, excuse me, it sounds like the lawn crew just came out. If the current administration has their way, my lawn crew is going to be gone very shortly. So we won't have these interruptions, and I'll have a really crappy lawn. We need to figure out where these two implied volatilities are going to head to tomorrow. All right, there's a couple of ways we can do that. If you've got Thinkorswim, I love a tool called ThinkBack. So let me just show you a really simple thing you can do. This is actually information that it's not impossible to figure out. It's actually very reasonable to sort this information out. All I have to do is think, if I did this trade in the past, what would have happened to the implied volatility of this exact same trade in the past? I go jump back to the earnings announcement on October 27th. I've got another one here on July 28th. I got one on April 21st. I got one on February 1st. And I got one on October 22nd. So I'm just looking at all of these. Use a little tool called Think Back. Let me reset this. And I'm just going to do one. I actually have already gone through this. But if I jump back in time to October 26th, earnings announcement happened on that night right here. Now, actually, let me show you something. This was the earnings announcement. Notice the implied volatility up around 81%. This was last time 46, 37, 31, 29, 26. Same exact pattern that we've got right now. This is the evening before the earnings announcement. I go one day forward, and boom, all of these drop right down to a fairly nice little level. So if I take a look at the options that are roughly 30 days in the future, I can see that the implied volatility on those is somewhere around 17.5 to 18. All right, so I've got that as a sample. All I did was I put myself in the same position back in time and saw what happened. You'd be amazed that the implied volatility stayed pretty darn consistent each time. I've already done the work on this, so I'm going to jump forward. Normally we'd go through this step by step, but I've got on October 27th, it jumped to, or dropped down to 17%. On the July earnings, actually it went way down to 14%. On April was 19%. Now, going back to February, remember, you got to remember the context. Always remember this context here. February was in the middle of a massive correction in the market. Everything's implied volatility was high. You need to take that into account. The implied volatility on that one dropped to 28%. All right, so probably not the best sample. But the October before that was 20%. So aside from a couple of moderate irregularities here, I've got a relatively consistent set of samples, and I can probably make a moderately conservative estimate that IV is going to drop from wherever it is right now to roughly 18%. That's what I'm shooting for. So, quick little calculation, and let's see what the reality is in this trade. Let's see, 23.95 plus 22.39. All I'm doing is the average of the two implied volatilities as they stand right now. Average of 23.17. My adjustment on this needs to be 5. Okay. So I'm taking February 24th. If you go to this little gear, you'll see that we can adjust the volatilities. And I'm going to subtract 5%. Okay. Now, did you see, pay attention to this P&L chart when I did that. I'm going to change it back to 0. It's looking amazing now. In fact, it's almost too good to be true. Well, it is too good to be true. With a little bit of reality applied to it, that is what we're looking at. Now, we need to figure out whether or not that is a good trade for us. So, a couple of things we need to sort out. A couple of little kind of tests that I'd like to do here. By the way, don't worry about the size yet. We'll fix that in a moment. But I need to make sure that the trade is a smart trade. Now, a couple of things to note. The middle of the trade has this saddle. I do not want this saddle getting too darn close to 0. I like to see at least about a 10 to maybe even a 20% return at the bottom of this saddle. That gives me some wiggle room. If implied volatility drops a bit more than I expected, I'm safe. There's a lot of things that you really want to be careful about. One hard and fast rule is if the bottom of this saddle in the P&L gets too close to 0, I walk away from the trade. It is not a good trade. Another thing I need to pay attention to is what is the realistic range of profits that I can get. Now, this is going to be expiring on Friday, literally almost no time before expiration, so we're seeing, in some ways, pretty close to what we're going to see tomorrow. In the morning, we might have a little bit extra profitability around here. In the afternoon, well, in the morning, we'll have less profitability in these ranges, and it will rapidly move up to the spikes. So if I have about $8,500 or $8,000, let's just say $8,200 worth of potential profits here, about $2,000 here, I'm just going to get a rough average between those two. So 8,200 plus 2,000 divided by 2. I can look at roughly a $5,100 profit on this, And based on the numbers I've got right now, that would be on a $10,300 trade. We're not doing $10,300, by the way. That's a 49% profit. Okay, that's something I can work with. So P&L wise, I've got a reasonable, return that I could get out of this trade. I need to basically assess some risks. By the way, before I move on, I just wanted to point something out. You remember our short strangle we put on first, and how we marked off the break-even points? That were these. By adding in these long options, we actually made the trade work further out. We created a limit, a max limit to our risks, and we actually made it so that we can make more money near the strikes, because those long options will be going up in value. We're playing all of this together. Now, I need to do what I would refer to as a sniff test at this point, just to make sure that I am comfortable with this trade. Things that can hurt this trade. Two major things. One, implied volatility drops more than expected on the long options, goes below our kind of average of 18-ish here. Or two, we have the stock gap further out than we want and go below 807.46-ish, let's just call it 807, or above 903. Now that is a heck of a wide range. It's almost a $100 range in there. But let's just see what has happened on earnings announcements in the past. All right, last earnings announcement on Google, not much. This one gapped up a little, 766 up to 795, number 92-ish. So basically 30 bucks. That would have been well within that range. This one gapped from 778-ish down to 744. So that would have been out towards the outer edge of the range, but still perfectly fine. Opening gap, nothing significant here, but it did move a lot in the next couple of days. A little bit of a gap there. That gap would have been putting us near the outer edge. Now, this one does worry me. We have in the past had, and by the way, this one was like a 2.5, almost 3 standard deviation gap, if I remember right. This was back in 2015, a couple of years ago. We had a very large gap. So this does represent a risk. Outside of that, the majority of all the earnings announcements are very reasonable, and the gaps are not particularly crazy. What would happen to us if this were to happen again? Hold on here. Raghu, after earnings, IB crushes, how does this impact the trade? That's the whole core of the trade. That's what we're talking about. We're using that for this. As the IB crashes down, the value in the short options goes down towards zero, basically handing us money. We have to basically bounce that off against a little bit of a loss, hopefully a small loss in our long options. The long options will increase in value as long as the stock moves out, but after you get to the strikes, then you get this loss from the short options losing money. All of that mixes together and basically creates the trade. That is what we're doing here. So what does the IB crush after the earnings announcement do? It gives us this opportunity. That's exactly what we are doing. All right. Do I ever use the probability of touching on Thinkorswim to determine the probability of hitting your outer strikes? Hell no. Okay. Let me explain. The number that they use, and okay, little bit of background. I am a horrible, horrible math geek. I love math. I have all my life. When I was young, I actually had, I don't know what caused this, but had an opportunity to get recruited up to the University of Maine at Orono's robotics lab. They gave me a chance to do research with them, artificial intelligence research, mathematical modeling. My high school was very good and allowed me to go up there a couple of days a week and work with them. I love math, I love modeling, I love doing all of that stuff, which turns into the other side, which means that I have an immense, horrible, horrible pet peeve for bad math. That probability of touching number is one of the most BS numbers you will ever see out there. Let me explain why. They use implied volatility to determine what is the probable range of what's going to happen in the future, and then they use that as a quick little calculation to figure out probability of touching, and then it basically circles all back around. So why is that bad? because it is absolutely 100% meaningless. If that number were actually correct, what it means is that it is using the implied volatilities as a pure, what's called a risk-neutral number, which means if their number is right, your trades on average will never make money. Never. You will on average win about the same amount as you lose. They're not taking a ton of things into consideration in there. They basically took the shortcut and gave you this number that is flashy and cool to look at and effectively meaningless, because probability of moving turns into, basically turns into the price of the options. The price of the options turn into implied volatility. Implied volatility is then used to calculate the probability of moving. It's a great big circular argument mathematically. So, do I use that number? No. I stay away from it just so I don't get pissed off. Please don't use that number. You can do something similar working off of historical volatilities and actually get something a lot more realistic. But that number is not a good number. Okay. You got me on a rant. Sorry about that. Nadex. Oh, the binary options and stuff? Oh man, those, please don't go there. Those things are horrible. They are flat out biased against you right out of the gate. Now, let's answer a couple of things. So it doesn't matter if it jumps up or down, but down would keep the IV of the longer options a bit higher. Absolutely, Robin. That would be a good thing for us. A gap down within our range actually helps us out a little bit. It's not going to make everything wonderful, but it will tend to keep things no problem, Neil. These are my war stories. I mean, I'm like I said, I'm a math geek. You want to know what I do for fun? Okay, this is probably horrible, but here, this is my fun. This is what I'm doing when I'm not in class. I was doing an extraction of the data from the CME on the futures contracts on the short-term treasury notes and using that to predict out the probability of a rate hike in the future. So I'm basically looking at what is the probability of a Fed rate hike. There's my war stories for you. And by the way, when I finish those, I share them with everybody. All right, trade. Let's finish this thing. Hey, John, if you are an Excel geek, I have a little group. It's not overly active yet, that I'm trying to build up and get to be fairly active, where we're all working on these Excel projects and the analysis tools. I share all of my proof of concept spreadsheets with everybody. We plug away at them until we get to the point where they're a good usable tool, share information back and forth, and then once it's done, I share the spreadsheets with everybody. If you're interested in joining that, reach out. Actually, just say something to Annie and I'll get you an invitation to that group. Wouldn't be finding the value of PI be easier than figuring out a rate hike? Mark, what's happening is that the exact values are not, they're more of a probability range. And if you just assume that that generates the exact answer, you're going to be a little bit off about what's going on. You want to find the probability distribution of the chance of the rate hike happening, and that gives you a better sense of what's going on. And that can be pretty important numbers. You know, is it a 51% chance of a rate hike, or is it an 80 to 90% chance of a rate hike to a certain level? And by the way, it's a probability of it landing at that specific rate. All right, let's get back onto this trade so that we don't get too distracted. We have gone through this. Bluntly, I've got one example here that is not great. It's a little bit of an unnerving gap. I'm kind of curious on this one. Let me just do one quick test on this. On, let's see, July 2015, let's just see what happens to the implied volatility. I just want to know what went on this one. And then we'll finish this up and move on. Oh God, what was that? It was July what? 16th, okay. By the way, this is way back, so this is, I don't consider this like a highly relevant situation, but Okay, so the day before we were at 119 and dropping down to 31, 28, 25. Okay, go one day further, we dropped down to 29 and implied volatilities went down to, see, implied volatilities dropped down to like 23, 20, 22, 23%. What happened, that was such a large gap, implied volatilities did not drop as much as we would have expected. Let me see here, 16. In fact, the implied volatilities in that situation barely dropped at all. So we can use that as in our analysis. Now, are we comfortable with this range? Are we comfortable that our analysis is right? And do we want to take the trade? There we go. That's basically the final question we have in this situation. Let me point something out. If we were to have a fairly massive gap, a large one, there's an interesting thing about this trade. Let's see here. That if you get an exceptionally large gap, the implied volatility in the long options does not drop as much, and it ends up making it so that, well, in theory, you lose less than you would expect. So let's just say that instead of dropping 5%, this only dropped 2%. That actually moves our break-even points out even further. In fact, that gave us almost $10 on the upside and, yeah, another $8, $9 on the downside of room. It would have reduced our losses out here. Even if things were to gap a huge amount, the trade itself actually somewhat protects itself. It's what I would call a graceful failure. The nature of the failure causes the implied volatilities to stay a bit higher than you'd expect, and it gives you an opportunity to get out of the trade at a reasonable loss. Not that any of us like losses, but I would rather take a small loss than a big loss. So, do we like the trade? Will the record of this be available? Yes. Everybody gets access to the copy of this. John, I use a bunch of different websites. I actually personally like this one. Ugly, but very, very good data. Earnings Whispers. Zacks is good. You can get stuff from Bloomberg. Yeah, we use a lot of things. Basically, I use whatever tool helps me. In general, I think this is a pretty decent trade. It's not the best trade. Would have liked to have seen it a little bit better, but this is pretty solid. This is looking good. So, we need to size this. What is a reasonable size trade here? Anybody have anything that would anybody have any reason why this trade, like a serious piece of information that says this trade is not a good idea? Always want to think about this in these terms. What is out there that could, that's out of the normal, that is not something you would normally expect? It's not a normal piece of the earnings announcement or any of the other things that are going around. Is there anything that is sitting out there that would make this earnings announcement radically different from others so that we can't trust anything? At this point, I don't believe there is, but exactly, John. Speak now or forever hold your peace. Trevor, do I use my market maker moves when I do diagonals? I use them for just rough estimates. Once again, market maker moves are based off of the implied volatility. It's a bit of a circular argument. You still need to use a bit of a judgment call as to whether or not you believe that the actual movement is going to be kind of what's expected. In fact, you want the market maker move numbers to be high in general, because in these trades we're essentially joining the market makers, selling the premium to generate our profits. We want it to be high because we want to be paid a lot of money for taking a low risk. Well, market maker move numbers are being calculated from implied volatility, which is the lot of money side of that equation. I will use the market maker move numbers as general guidelines. I do not use them as a gospel, this is the Bible, this is what you do. By the way, I really don't like doing that period because it shuts off your brain and you stop thinking. You turn it into your trading becomes ritualistic instead of actually using your head, and I don't like that. I find it doesn't make you money. All right, finish up the trade. I like this. Yeah, Mark, I'm seeing some weirdness. Mark was saying IV seems to be one not to trust this earnings season. I am seeing a little bit of weirdness this earnings season, and we do go through earnings seasons where things are not quite normal. Google is a pretty stable one, very, very well followed, very consistent in general. Is it possible that earnings or implied volatility will hurt us on this one? Yeah, we'll take a look at that. In fact, here. If right now I'm expecting about 17 to 18% IV, if this were to go down more, implied volatility drops more. Let's say it drops 7%. Now the trade at this point, if I believe this is my real target for implied volatility, the trade would not be as good, and I would probably not. If I was looking at this and I estimated this as my real expectation, I would look at this, see this profit line below zero, and not take the trade. I walk away. Now, I try not to get too overly, I don't know how to describe this, I try not to get too overly reliant on being a perfect predictor. I'm just trying to use general trends overall. So in this case, I'm really just going to use the information that I had, and I'm feeling pretty comfortable in that 17-18 range. Even if this were to lose a little extra implied volatility, we're not at a lot of risk down here. Notice we could have still made money in that trade. I just had less profit and less range. So one of our big enemies is, does implied volatility drop more than expected? Knock on wood, hopefully it doesn't. We'll see. But I am going to use the range that I've got right now for the estimate, and I think that this is pretty decent. But it is absolutely one to consider. And if we get a whole bunch of trades this earnings season that seem to drop more in implied volatility than normally is happening, I'm probably going to be more and more cautious. In fact, based on the data, the samples I got, normally I probably would have estimated this with a higher implied volatility. But I actually went a bit lower this time. So, all right, do we like it? I generally like it. Let's size it and see if we can turn it into a trade. Richard, why not use February 3rd instead of February 24th? Very good question. Let me show you why not. By the way, the answer may be that is the right answer. But let me show you what's happening here, because that is actually a pretty core piece of the trade itself. Notice that the implied volatility on the February 3rds, and by the way, he's referring to using these as the long options to protect us. The February 3rds have an implied volatility of about 36%. In fact, let's take a look here. Mm, 35, a little up, yeah, somewhere in that area. This implied volatility is going to drop down to roughly 18%. So if that happens, then because the Vega dropped, we're going to see the price of these options drop. And that is going to cost us money. Now, if the overall value that drops out of these options is more than the credit we receive from the trade, we end up with a trade that looked like I showed you a second ago, with a big saddle underneath. We want to minimize the implied volatility drop because that's going to help us minimize the cost of the protection side. So if I switch this trade over real quick from February 24th to the February 3rds, and I adjust this, yeah, there we go. These currently have about, let's just say, 35% implied volatility on average. That needs to go to 18%, so we've got 17% drop in implied volatility on those. What happens to this trade using the February 3rds? Minus 17%. Yeah, that's what I'm trying to avoid. All right, does that make sense how that all worked? We've got a greater drop of implied volatility on the options that expired closer to the earnings announcement. Think of it as a blast radius. They're exposed to more risk. When those drop in implied volatility, and remember, the reason those are there is that they are going to be protecting our portfolio. And the cost to us is, what do we sell those for later on? We want to sell them for as much money. If we have a big drop from a high IV down to a low IV, we lose a bunch of money on those, and it hurts the trade overall. By going further out, what we're doing is we're getting further down the curve of the IV drops. closer to what the final implied volatility is going to be. All of these IVs are basically going to come out to within 1% or so of each other tomorrow afternoon. They're all going to be dropping to roughly the same level. So we're just avoiding that extra risk. All right, let me reset this to the February 24th. You know, if you want to, it's a good exercise of actually doing that on every expiration. In my Wingman Group coaching group, we actually did a bunch of that the other day. We took and stepped through it step by step by step and saw what each one of the expirations was going to do based on our target implied volatility and how that affected the trade. You get a really good sense of what's going on. And, you know, sometimes you get a quirky situation where you actually get a better answer than what you expected in another place. So it's worth putting the effort in. You want to make more money? Work harder. All right, sizing. We need to adjust this for some risks. We need to find an appropriate size for this in our portfolio, and we need to basically decide how we're putting this thing on. When we're looking at these, and by the way, Google, $800 and some odd is pretty expensive stock. You know, normally things are a lot cheaper than this, and the trade is a lot less expensive. Most of the time we can size it to almost any size we want. This one might be a bit of a challenge. $10.20 is the max loss we could take on this. Things blow up on us. So, from experience on this, why not use the future out options? Because the further out you go, which is the flip side of the question somebody asked a second ago, the further out you go, the more expensive those options are. The Vega factor in those options is actually larger, and there's a point where if you go out further, the high price of the options reduces your return on investment, and the Vega factor is higher because they expire further in the future, and that actually causes you a greater loss. There is literally a sweet spot to this trade, an almost perfect point where you're getting the least amount of expense to protect your trade. If you go too far out, it hurts you. If you go too far in, it hurts you. You're trying to find that nice little spot in the middle. And actually, yes, I am actually working on a spreadsheet that would analyze that and give you the answer to that as the, you know, what is the perfect point right now. Don't have it yet, so have some patience. All right, $10.20 max risk. From my experience in this trade, I find that probably 90 to 95% of the time, if the trade fails, I can limit the loss to 40% or less. Now, that does not mean there isn't a black swan out there somewhere. And let's be realistic about managing this trade. We are dealing with what we're given tomorrow morning. That's it. You know, I can't magically make this better. I can't wave a magic wand and suddenly make volatilities change. I am given what I've got. So the idea that we're managing the risk on this is a little bit of an illusion. We're estimating the risk to figure out what is a reasonable size trade for this. Now, as I said, I, from experience, know that this type of a trade, I should be able to limit the loss on the trade to about a 40% loss the majority of the time. I actually was in Google when it did that gap. I did this trade on Google when this gap happened, and I lost. Now, take a look at how large that gap was and how big a surprise that was. That loss was a 50% loss. I remember the trade very, very well. Now, considering I'm kind of basing my whole premise around 40% loss and an extreme situation, which is unlikely to present itself anytime again too soon, knock on wood, only made me take a 50% loss, that gives you a little sense of the level of control we have. Is it perfect, and is it possible that we could get a greater loss? Yes. But I'm basing this around what my general expectations overall are, and that's 40%. So let's take a look at this. Times 0.4. That means that every one of these I put on, I would lose $4.08 if I kept it to within 40%. Now let me say something, be clear about that. It doesn't mean I'm expecting to lose 40%. It means that I believe that the majority of the time I can limit it to roughly 40% loss. 40% in this case, $4.08 times 100, $408. Now, I have a portfolio for the ALTB group, which is a paper-traded, hypothetical $100,000 portfolio. We use that for basing our trades and basically sizing things. In that portfolio, I need to spread my risk around. I want to balance out that portfolio by risk. So I'm allocating a certain portion of that portfolio to the risk of each trade. From experience, from analysis, from just kind of working through stuff, I find that about 2.5% of that portfolio assigned to each trade for risk is good for the style of trading I do and for the style of trading we have. It allows us to maintain a portfolio which is pretty broad. We can have 10, 8, 10, 12, up to 15, maybe even 16 trades periodically. Gives us enough room to do that. We can have a well-balanced portfolio, diversified portfolio, and any trade, any individual trade itself, I'm focusing on what is the likely loss if things go very bad. I can live with a 2.5% loss. Not happy with it, not excited, but I can live with it. And I've also got a lot of other trades that are simultaneously making money and offsetting that loss. So if I do that, 2.5% of $100,000 is $2,500. If I lose 408 on each one of these, 2,500 divided by 408, I should say take 6.12 of these, which doesn't work in the market, so I just round it down to 6. Great. Now, that is the trade. How are we going to manage the trade? A couple of different things to pay attention to. First of all, we need to make some decisions. What am I going to put in for a rough profit target on this one? If the bottom of this is about a 20% win, the top of this is about a 70% win, and my average throughout this area is about, hey Wiz, you're back?
I am. I'm back from career day, Doug. So if you need any mutual support or you need me to boot anybody out of the room, I will. So I'm your mutual support right now.
No, we're all good. Everything's good. In fact,
all right.
By the way, you guys have been good. I'm sorry. I try to keep up on the questions, but this Q&A thing really kind of stinks, and I got a lot of people asking questions here.
Hey,
it's much better than go to
Yeah, and I know Doug covered this 50 times. His head's probably ready to explode. We have nearly 1,000 people in here. Doug wants to answer all of your questions. He can't. I spoke with our customer support, Annie, on the way back from my daughter's school, and we're almost full of our full throttle slot. So if you're waiting to see Doug, you've seen Doug. I'd go grab my slot now before I get on at the end or tomorrow and say there's no more. So Doug, I'll get out of your way and I'll wrap up at the end, buddy.
Yeah, my recommendation is jump on board before I actually go too long and you get sick of me. So, all right. So anyhow, average return on this one would be about a 50% return. Let's be a little bit, a little conservative here. Let's try to set up a situation where we've got a pretty high probability of winning. Very similar to Comcast that we had before. I'm going to go for about a 30% profit margin on this one. So, laying out the details of the trade. If I were to make 30% on this, what would the price be? All right, $10.50. By the way, I'm going to stick in 8 cents. Just 8 cents basically should cover my commissions on this. I like to try to bake that into this particular calculation a bit. So $10.50 plus 8 cents. Cost is about $10.58 times 1.3. If I hit $13.75, I would be walking away with basically a 30% profit on the trade. A little bit more if you're not counting commissions, but commissions are not a major factor in this particular one. So I would basically be using that as my profit target. And how do I do that? I put a good to cancel order in today, leave it on, and let it go through the market open tomorrow. And here's the thing, just like Comcast, just like we saw earlier, if this gets hit, wonderful. We walk away with a beautiful, nice, quick, money in our pocket trade. Didn't have to stress. We just got handed a wonderful little overnight win. If it doesn't get hit, we do just what I did this morning. I make some assessments about where the price is, what's the value, what's the possibility of the win, and I might adjust my target down a little bit and we pick out the 20%. Periodically, we have other things going on. Let me talk about those because we got to know how we're going to deal with this if things go bad. So, one of the things that I use as a general rule of thumb is I take the strike that I've got on the bottom, and basically look for about the halfway point between that and the break even. This is just roughing it in. It's right about there. Okay, 817. I would use that as a bottom threshold of the trade. If Google were to gap and go below 817, that is my GTFO point, my get the heck out point. On the same thing on the top, about 894, 895-ish, same thing. Now, I don't have to be perfect. These are just rough numbers. But I want to keep myself disciplined so I have a good, solid idea of what I'm going to do on this trade. I am going to exit the trade if I see Google gap above this or gap below this. Now, in the middle of the trade, what do we have for different possibilities? There's a couple of interesting things that go on. In the morning, if we are out near one of our strikes, 825 or up near 885, we're not going to be seeing this $5,000 profit at that moment. We might see a pretty solid profit. In fact, it might knock us out of our trade with a nice hitting our profit target. But there's an amazing amount of theta erosion that happens in our favor between when the market opens tomorrow and when it closes tomorrow night. You got to balance that off. Do I want to sit in the trade? Do I want to risk it? Do I want to hold on to it? Do I want the stress of following this stupid thing all day? Or do I want to take my money and go? It's kind of up to you, but I will point out that you may have the possibility of making a greater profit if you leave the trade on, as long as the trade is relatively close. You know, let's say about 875-ish to probably 890, 894 range, somewhere in that area. If it's around the peak, you have the choice of leaving it in. Most likely, I'm going to close it out tomorrow morning. On the flip side, if you're sitting right in the middle, around 850, now let me give you a warning about this. If Google does not gap at all, I mean it's dead flat, there is a chance that our implied volatility could drop more than expected and put us into a little bit of a loss here. Not a huge loss, probably 10%, maybe 15%. You know, it's kind of one of the risks of the trade. If that does not happen and you're still in this low range, you have a chance that the trade is actually going to go from whatever profit you've got at that point down to a lower amount later in the day. There's a little weird spot in the middle here where theta erosion is actually against you. So if you're in this range, I really encourage you to close the trade out first thing in the morning. Don't wait. Not unless you believe Google is going to shoot up to one of our strikes. So there is the general game plan. Whatever happens, no matter what, we have this trade entirely closed by tomorrow afternoon at 4 o'clock. So why is that? Because if we don't, our short options expire, which is great. I like that happening. But our long options get left over the weekend as a long strangle coming out of an earnings announcement. Two things are going to happen. One, we're going to have several days of theta erosion, which is going to suck. It's going to hurt that trade. And number two, typically in the couple of days following the earnings announcement, implied volatility settles down a little bit more, which is also going to hurt that. Lots of things against that situation. Unless you believe deep in your heart that Google is going to shoot up or shoot down, and I'm talking about making a big move, do not leave those long options on. That's danger. It'll leave you very exposed to losing some extra money. So there is the game plan. And I am going to basically fire this off. Let's see. Why do you have the data in your positions and simulated trade bar at 127? The reason I have that at 127, and I'm actually just ignoring that right now. I should do this. That gives you an intermediate P&L. Let's just ignore that. In these trades, it gives you a really quirky set of numbers that are not very accurate. I have to actually work a little bit more from experience in these than the way that Thinkorswim works on these super short-term implied volatilities and P&L charts. So in this particular trade, ignore that. Change it to something where you've just got one final P&L. All right, confirm and send. Sending this to my ALTB group. And anybody have any final questions? All right, we have an order. Mark right now is 1056. I'm sure that there's a bit of a bid-ask spread out there. Yeah, fairly wide bid-ask spread. Not outrageous, though. All right, we wait. We have a little bit of patience. I would, if you wanted to get into this as a paper trade, I would probably be willing to chase this up to maybe 1080. I wouldn't go too far. 20 cents either direction would be fine. If you can get a decent fill at 1060, you're in great shape. I'm going to just leave this on for a little bit, see what we get for a fill. Okay. What if Google goes to 900? Well, if Google goes to 900, hold on. If Google goes to 900, well, if everything else goes roughly along what we expect to happen, we will walk away with about a $600 profit. If Google goes to 901, we will walk away with a 450-ish profit. If Google goes to 905, we will walk away from this with a roughly, remember these are all estimates, $607 loss based on this size trade. It's a trade. It's not a guarantee. I'm not sending you a check. I'm sending you an opportunity. We analyze all of them in terms of what are the risks of failure, what are the risks of winning, or what is the possibility of winning. In this trade, I like the overall possibility of winning. I think it very much outweighs the general risks we have. Am I going to win every one of these? Heck no. Do I win the majority of them? Yeah. When I win, and people who've been with me for a while can back this up, we're looking, pretty much on average between, say, 25 to a 50% return on the trades. We're winning quite often. Periodically, we have a loser that eats into our overall profits. It's part of the game. It's a statistics game. We've got literally almost probably 100 of these that we could possibly be doing over the next 3-4 weeks. We're not going to take even close to that. We cherry pick the best we find, and we take a handful of them. But it's part of an overall trading portfolio. So whenever you're trading options, absolutely, I won't even talk about it every single time, but understand every trade has risks. So there we go. Trade, where do we stand? All right, I'm going to do this with a disclaimer. I am doing this so that I can get a nice clean fill for the group. I try to be consistent, very consistent about one thing. When I trade like I teach. My trades are basically the same concept, same ideas. I'm doing them slightly different times, so they may not be the exact same strikes, but it's the same concepts. What I'm about to do now is actually different from how I normally trade. So I just want to be very clear about that. When I trade with my live money, I would have a tendency to work for a morning and nail down 4, maybe 5 possible trades. And I'll be putting those on. Oh, see, patience is good. I will be putting those on, and I'll be sitting there, and I'll wait for what just happened right there to happen. I'll wait for my fills. I do not like chasing prices. Now, periodically, I really want to get us into a trade because the trade's got a lot of educational value and we want to follow it. So I'll get a little aggressive about getting in. I don't like it. I don't like that as a strategy overall. I would rather put the effort into finding more trades, giving me the opportunity to get filled at good prices rather than take one trade that I'm really excited about and chase the price until it's a bad trade. But luckily, in this case, we got filled at $10.60, just like we laid out, and we are in good shape. So let me fire this off. Hold on, I need this. Okay.
Hey Doug, while you're typing away here, somebody asked, when does Doug wear his uniform? We need to have uniform day at Top Gun Options, bro.
My BDUs, oh God, please, I think I burned my dress blues, but or actually dress greens. They weren't blue. They're a horrible color green.
Exactly.
My BDUs are still muddy. Way too much time sleeping in the mud. That was not the fun thing. But we got to blow stuff up, which was cool. That was a lot of fun.
Exactly,
Okay.
man. That's awesome. So to answer, who was it, Mark or Trevor's, whoever had a question, we're not going to be wearing our uniforms again anytime soon. So hopefully Doug's going to be wrapping up soon, and I'm going to get out of this ice cream man outfit.
Yeah, and by the way, you see me in a collared shirt right here. Let me give you a little reality check on that. I don't think I've worn this shirt for probably 6 months. I live in Florida because it's a nice, wonderful, warm place to live. I have my flip-flops, I have my shorts, and I have my T-shirts. I used to work on Wall Street, and I used to work on LaSalle in Chicago. I don't want to go back to that. I do not want to be sitting in dress uniforms all the time. I do this because I have freedom, not because I want to be in a tie.
Folks,
Alrighty.
I think we're lucky if Doug is actually wearing pants today, so he nailed that.
It's rare that I do one of these naked. Okay, just no, I wouldn't do that. But it's
Jason.
I don't.
Jason said, "Don't stand up, Doug."
All right. Let me fire this off. Okay, sorry about this. Getting distracted here.
Hey, folks, as Doug's firing that off, I'll fill some of his dead air. Obviously, I don't do this regularly. I eavesdrop sometimes on Doug's advanced live trade briefs on Thursday morning. Why? Because the guy, I might take one of his trades to do into my own account because the guy's a hell of a trader. I've been playing phone, Skype, and everything tag with Annie. We are, I don't think we're completely full, but we are almost full with all of our annual memberships here at Full Throttle. So again, if you waited, all right, Wiz, yeah, you're a hoot. Let me see what this Doug guy's all about. You saw Doug last night. If you didn't see Doug last night, you should see him on the replay page, his vertical spread training. Had nearly 1,000 people in there last night, and I'd say 90% of the comments were like, this guy's a hell of an instructor. He is. He demonstrated last night vertical spreads. Demo do, just like I'm wearing my uniform today. In the military, somebody demonstrated something to Doug and I, then we went out and did. He's doing now, folks. Demo do. So if you're waiting a little bit to pull the trigger on getting a slot, and Rick, another Oregon. Rick from Oregon, Full Throttle Max slot. Welcome aboard, Rick. We're going to be done here, guys. Even if we get our 50 today, like I promised, Doug and I will still fly the flight schedule tomorrow. We'll do a little debrief at 1 o'clock for about 20 minutes. I'll kick Doug out because he's got a trade, and not only for us, but for his hedge fund. And I'll do my weekly options brief. But I think at the rate we're going here, we're going to be full today. And for the 3 people who just said, hey, I called Annie or I emailed support to save me a slot, I can't save you a slot if somebody is grabbing it right now. So as Doug finishes up his trade, just let me put the page to grab your slot. And it's funny because people are like, okay, yeah, they take more than 50. And go to training next week when you can see people's comments. Ask some of your fellow members who tried to get into the last or the August Full Throttle, who were number 51 or 52 who tried to get a slot. We don't, man, because I know Doug and I go crazy not being able to answer everybody's questions. So there's the page to get in, and here's the replay page in case you need it. And then I'll get out of Doug's way because I think he's done with his trade here. Got membership last night. Douglas, welcome aboard. Your name does look familiar. Great discussion on the math of this trade, Doug.
Great name, by the way.
Exactly. Well, his name is Douglas. I think you're Doug. Great discussion on the math of this trade, Doug. Best I've seen on double diagonal. All right. Well, that was a compliment to you. That wasn't to me. So, Doug, let me get out of your way, dude, and I'll wrap up here in a little bit.
Okay. Got a little bit of maintenance. By the way, you guys, everybody who's here, whether you're in for the promo or full-time customer, I've sent out the alerts for the text alerts, so that gives the basics of the trade. When I'm done, I'm going to turn around, write up a full write-up on the details of this trade, give you all of the things that we've got for managing it, profit targets, all of that stuff. And I send out a full report on the trade. You'll be getting that in a little while this afternoon. It takes a bit of time to get everything done. That'll give you all the details, and that's for the people here from the promo also. So you got that. Hopefully that's an interesting trade. Did anybody learn anything from that? Hopefully you got a little bit of knowledge, a little bit of understanding of what's happening in that situation, how we're turning it into a profit. In a lot of ways, that's what we do. We understand how things work, and the beauty of the options market is it's complex. Now, I know that that sounds weird. Why would you want something to be complex? You want it to be complex because if you know a little bit more about how it works than somebody else, in fact, more than the average person in the market, that's where you get your edge. That's where you get the ability to make money. So if we can use our knowledge to do trades which give us a high expectancy, decent solid return over time, and other people are making mistakes like putting an iron condor or something on this, or one of my favorites is buying a long strangle, which is, please don't do that. Tell people you don't like to go do that. That's the people that we're using to make money for us. So we want to try to do this. So hopefully this is useful. Hopefully you're walking away with something valuable here. That's my goal. All right, I got to do something real quick. We need to do a tiny little bit of maintenance on this. We've got a trade that we've been in for a little while on Whole Foods. It is a pre-earnings trade, which is actually just like the earnings trade we did, except it happens before the earnings announcement ever happens. Instead of trading the implied volatility going down and crashing, we're trading the implied volatility going up. And I need to take my profit. So for everybody who's one of my regular members, we are closing Whole Foods at a 109 credit rate now. And let's see if we can get a fill on that. That should be a nice $1,600, $1,700 profit. And yay. Okay. Now, by the way, if that was something that we already had on, that's not for the promo people, that's for my regular people. And give me 1 second, I'm going to fire this off so everybody knows what's happening. We just walked away with a nice profit. If you want to be on those next time, then join up. Hold on here. Let's see. Oh, that's not what I needed. Sorry, it's always a balance, Try to make sure everybody gets the information just as quickly as possible and try to, at the same exact time, pay attention to everybody in the group. Just going to bear with me for a moment.
Wayne Warling, thank you. Educational, excellent, greatness at its best. Thanks, Wayne. Well,
appreciate it.
Not thank you to me. Doug's the one that's talking, but Wayne, thank you. Folks, let Doug henpeck back and forth as he's doing. And 2 more slots, a defensive annual and an offensive annual just went as well. So it's, no offense taken that you guys wanted to wait until you met Doug to grab your slot. I'll leave it at that. But folks, if you haven't spoken to Annie, like, hey, I need to move some stuff around and grab my slot, or you're not going to grab one today after Doug, we're going to be full here pretty soon. Somebody asking a question about Options House. You're looking at Doug. Doug uses Thinkorswim. I used Thinkorswim for a while there. I know Tom Sosnoff very well, who built Thinkorswim and then sold it to InvestTools, who sold it to TD Ameritrade. It's just like Options House. It was Trade Monster with John and Pete Najarian. I know John and Pete really well. If you guys watch Comedy Central, CNBC, you see John and Pete all the time. They sold Trade Monster to Options House. I helped build Options House, and now Options House is E-Trade. So you can trade with whoever you want. As you can see, even if the trades I put on in my Options House platform, if you're Doug right now, you can go in there and put the same type of trade that I put in an Options House. quick discussion about pricing and volatility and everything. Each one of these brokers has their own, and Doug can tell you with his 500-pound head, secret sauce. So, because sometimes I get some of the booger eaters who are like, well, Wiz, on my Interactive Brokers account, the vol says this. I'm like, okay, dude, or you're 5 cents off. Really? It's a market, it's volatility, and the Black-Scholes model, and there's a third dude, I forget his name. What's the third guy's?
Let's see. Actually, there's a ton of them. If you want to go through, we've got Black-Scholes, we've got Birchman-Strendlin, we've got the binomial model, trinomial model.
Well, no, there was 3 guys. It was Scholes.
Yeah, Black-Scholes, Merton.
The third guy, exactly. It's like Larry, Moe, and Curly. It sucks. If today they referred to the Three Stooges as Larry and Moe. Could you imagine being a third dude? But it looks like Dunn. There you go. Rick got it. Nice job. I'm in line for safety work, so $1 per contract. Go ahead, Doug.
What's actually really funny about that whole thing, you've got Black-Scholes and Merton who are all involved in it. Merton was the trader who was an actual practitioner. Black and Scholes were over at the University of Chicago, I believe, Booth, and they got the, I guess, Nobel Prize in Economics or Finance or something like that for this. Now, the trader goes on and actually has an extremely good career. Black and Scholes goes on to found long-term capital management, which nearly blows up the U.S. economy. So
that's right.
There's the difference between the practitioner and the guy who just sits there and looks at the numbers.
LTCM. That's a great book too. If you got, I forget the name of the book, but reading about that blow up, man, that almost literally ended the world, is a great read. But yeah, it's just funny because people say, you know, the Black-Scholes model. I'm like, what the hell? What was Curly's name? Larry, Moe, and Curly.
And actually, the one that should get the most credit is Merton. He did a lot on that.
You're right. That sucks, man. So, the guy that did the most work got gooned.
Yep. I'll tell you what, you mind if I jump in? I just want to knock out one last thing. It's a little bit of a maintenance portfolio trade, but I think everybody will get something from it. I'm going to knock this out fairly quick, and then we're going to wrap things up. So is that good for you, Wiz? Nope, I guess he's gone.
No, you bet, man. Sorry, I was just Rick and TR and a couple folks reminded me the name of the book, When Genius Failed. But yeah, Doug, whenever you're ready to wrap up, I'll take it, and we'll head on back to base.
Okay, sounds good. All right. Quick little rhetorical question, or I don't know, whatever it is. Everybody here who is a little bit nervous, a little bit of anxiety, a little bit of, you know, when is reality going to hit this market? When are we going to see our next correction? Who here's got that feeling at this point? And I will raise my hand on this one. Okay. The level of anxiety that I see out there is pretty crazy. The worry that people have. What's strange, though, is translating into the market into implied volatility. Implied volatilities are actually amazingly low. Now, I'm not sitting here that I'm saying that I want the market to go down. I don't want people's 401ks hurt. I don't want their investments to get hurt. But the reality is this: we have a market that's been going up and up and up and up, and fundamentally, the earnings and growth has not really strongly been there. We're finally, after, let me see, what was it, year and a half of getting actually an earnings recession, we're finally seeing a little bit of positive earnings. But it's still not getting to the point where the prices in the market are realistic compared to the real values of the companies. It creates this big gap. Now, does that mean that the market's going to crash? No. Does it mean that there's a risk that it could crash and there's not going to be a lot of value players out there slowing it down as it drops, and it could be a fairly catastrophic drop? Heck yes. So, first thing I have to realize is, number one, I am not a genius who knows exactly what's going to happen. I do not have a crystal ball. Number two, I have to protect myself against the bad things that could happen. I want to do that in a relatively effective and as low-cost way as I possibly can. For me, my number one way, my primary way of protecting myself, is maintaining a portfolio of relatively balanced trades that's supposed to give us balance within the overall portfolio. Now, it's great to say. It's sometimes hard to achieve because the market doesn't always give you trades that help to balance each other out real well. But the goal is there. We try to move it towards that goal of having a nice Greeks-neutral, risk-neutral portfolio. And that, when the market fails, when the market corrects, is going to fail less than your average portfolio. We're going to take a loss, but not a huge loss. Now, the second thing I do, especially in times like this, is I actually create a hedge. Now, let's look at the reality of hedges. Hedges are a cost. They're an expense. I flat out do not expect this trade to make me money. In fact, if it does make me money, then I'm losing money on a bunch of other things. It's not necessarily the best outcome. But, do I have a house and not buy insurance on it? No, because if my house burns down, my life is ruined. Do I have a car with no insurance on it? No, because if I hit somebody and I hurt them, I need to have insurance to be able to pay for that, make sure that they're okay, and I need to make sure that I'm protected financially. This is the same exact concept. The next trade I'm about to do is actually fairly simple. I'll walk you through a couple of quick steps to figure out how to do it. I am trying to buy insurance on my portfolio, spend a small amount of money to protect a big portfolio, and number one, make sure that if something catastrophic happens, I can wake up the next day, go back to work, I have my tools in my toolbox, which is my cash in my account, and I can go back to making money. I'm not sitting there with such a catastrophic loss that I am crippled. So, just want to be clear about that, and the one thing I don't want to have is a bunch of people in 2 months saying this trade lost money. That's perfect. That's what I wanted to do, because that means that my other trades are probably making money. In fact, there's another reason for this trade that I'm about to do. Humans are emotional animals, and every part of that statement is correct. We're animals, and that we're stuck with these neat brains, and they cause us emotions. And the more emotional you get over trades, the worse decisions you make. I have never seen really high emotions create a situation where a trader makes a better choice. Never. This doesn't happen. You start making, I don't know what it is about our heads, but high levels of stress force us to make stupid, dumb, bad financial decisions. So, if I can put on a small, relatively inexpensive trade, which makes it so that I can ignore one of the major risks in the market, I can take stress out of my life, and I can focus on what's actually the most important thing about trades, and that's what is happening in the market. You've always got this balance of what's happening in the market right now versus what somewhere in the back of your head you think is going to happen in the future. You want to know what statistically is more right. What is happening now is statistically far more likely to happen in the near future than whatever it is that you're paranoid and thinking about. Now, it doesn't necessarily mean you're wrong, that that thing will never happen, but statistically you are more likely to be right if you just focus on what has been happening in the market. I can speculate all I want that the inauguration is going to cause the market to crash. Well, the market had actually been going fairly steady and fairly strong into the inauguration, and guess what? It didn't crash. Could it have? Heck yeah. Was it the statistics behind it likely to crash? Actually, no, it wasn't. As much as we'd love to jump on that idea as, we're brilliant because we know what's going to happen. Follow what's been working, what has been going on, that's going to be your best trade, but protect yourself against what you think might be a risk. So let's walk through this and let me show you how this one thing helps to protect us. So here is the concept step by step. First of all, you need to know what you're protecting. Critical. You can't do this without knowing what you're protecting. Let me give you a little guideline on how to do this. This is a great little exercise for you to figure out what you've got for risks. Now, it's work. And by the way, nobody ever told you, I hope nobody ever told you that trading isn't work, because guess what? It is work. Take your portfolio. Whatever you've got for trades right now, look at all your options positions, lay them out in front of you. Take those stocks and also try to figure out what is the number of days to expiration on all the different options you've got. So you've got a little list in front of you, and then you've got a homework assignment. Jump back in time. If you've got Thinkorswim, this is relatively easy. Other platforms a bit harder, but jump back in time to January 1st, 2nd, somewhere around there, of 2016. take those same symbols and look what happened to them over the next, I don't know, 2-3 weeks. Just pick a point. Now realize that if you were in this correction, you will not know you're in a correction for the first couple of days. Flat out, you won't know it. It'll be big moves. You might be worried, but you're sitting there thinking, oh, well, it's just going to bounce back. It'll recover. Guess what? It's a fantasy, but you're not going to know you're in the fantasy. So realistically, think to yourself, at what point would I be closing out these trades? Probably around day 4 or 5. Things are getting really painful. I'm hitting stop losses, eject points, all of these things. Take a look at the percentage drop on each of your stocks that happened back at the beginning of the year and apply that percentage drop to your stocks right now. That right there will give you a general idea, if we were to go into a new correction, how painful it would be to your current portfolio. Also, take a look at the change in implied volatilities, or figure out what the general implied volatilities were on the options that you were trading or that were going on back then. Look at the options and kind of estimate where the implied volatilities would be on your options that you've got in your portfolio right now. In a lot of cases, they will be very, very high. They'll jack way up. Now, in some trades, that'll be good. You'll make some money from that. Other trades, you're going to get hurt. You want to just run through that as a little mental exercise and figure out how painful your portfolio would be if we had another correction somewhat similar to this. You can do the same exact exercise, using any of these major corrections we had. The process works. Just use a little bit of data, figure out what's a good example of the market going through a failure, a real world example, and apply that, those numbers, percentage changes to your current portfolio. From that, you should start to get a pretty decent idea about a number. Based on your portfolio, roughly what would you lose if we had a brand new correction? Now, don't go into this with some Pollyanna-ish attitude that you're going to be this genius about closing out every one of your trades exactly at the stop loss and blah, 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 and that you're a perfect trader. Nobody is, especially when the market is coming down. You're going to have some pain. Also, don't think that it's the end of the world. We don't want an unrealistic estimate. We want something that is pretty darn close to the truth. Focus on the evidence and use a little bit of judgment, but work from the evidence to give you an answer. All right, we now have a number. Based on my general trading and on the general portfolios that we use in the ALTB, I know that we are probably exposed to roughly about an $8,000 loss, roughly. Could be a little more, could be a little less, depending on the situation. Some cases, we might even be coming out ahead. But we're exposed to roughly an $8,000 loss based on my normal portfolio. Okay, so there's number one. I need to figure out how to protect it. Honestly, this is not easy. There's a lot of different ways you can do it, and I've tried different things. You can use options on indexes, you can use options on ETFs, you can use options on a bunch of different things. All of them have their own problems. First of all, if I bought a long put on the SPY, realize what's going on with that. We've got tons and tons of theta erosion. That long put was actually fairly expensive for the amount of protection that I'm getting, and the theta erosion is going to erode that down. The protection that I'm getting down to zero, it's going to be harder and harder for that protection to work. And if SPY continues to go up, then a 10% drop in the SPY is actually further up from your put strike, and it's going to lose its effectiveness over time. So that kind of sucks. And by the way, I could go through that exact same discussion on a dozen different possibilities. There is no perfect solution. The best solution I've found is this, VXX. Now, let's be straight, right up front, there are problems with this, and it's not perfect. But out of all of the different situations, this basically has the least amount of problems and some of the most effective and cost-effective protection that I've ever found. VXX is based off of the futures contracts in the VIX. So we've got futures, actually the VIX Central page that I showed you a while ago. That shows you those numbers. Here, I can even do a really quick look at this. Okay, there we go. The VXX is actually a blend of futures contracts that expire less than 30 days in the future and more than 30 days in the future. And what happens is each day they rebalance this, so the average number of days in the future that the futures contract expire is 30. So every day they have to basically buy more of the long terms and sell some of the short terms. You'll notice that the long terms cost a lot, the short terms are cheap. That generates an internal kind of friction in the VXX, which then causes VXX to erode in value over time. All right, so now we know one of the problems. I'm going to be trying to use a symbol as a hedge that is eroding over time. Luckily, the options market knows that this is an effect and actually builds some of this into the prices. Not all of it, some of it. So that actually helps us a little bit. It's not as bad as you might think. Now, what does VXX do when we have a crash? In general, we will see VXX jump up to about twice the price that it's at right now. So if we have a correction, a large-scale 10, 12, 15% correction in the market, we're likely to see VXX jump to about double where it is. Problem is as it goes lower, double is a smaller and smaller amount. Keep that in mind. So we're going to try to build the best protection we can for the cheapest amount of money while considering some of these drawbacks. And if somebody comes up with a better solution, please let me know. I'm always open to new ideas, but this works for now, and it does a good job in protecting. I'm going to build a trade, and this is a trade we probably don't see a whole lot. It is a VXX bull call spread. Okay? Now, the reason we don't normally do these is they're incredibly low probability trades. Flip side of that is they're incredibly cheap trades. We're just doing this to do one very, very specific thing, and that is protecting our portfolio against a major move or major correction. Okay? There's no other purpose to this trade. In fact, I expect the money I'm about to spend on this trade to poof, go away and not be used. But having this trade on really clears my head, because when I'm sitting there saying, I don't know if I should take this because the market might crash any day, I am giving up an opportunity to make money. If I am using that fear of a correction or a crash in the market to walk away from trades, I am giving up profits. I'm losing money because I'm doing that, because I have a fear that something might happen. This trade is designed to allow you to walk away from that fear and focus on your trading instead of the panic that makes you make bad decisions. So, first thing I'm doing is I need to figure out where I'm going to start out on this trade. I want to be out of the money by quite a bit, and I'm actually trying to get what's called a leverage number on this up around somewhere between 11 to maybe 13. That's a kind of a sweet spot for this trade for me. So I am going to buy a long 27 strike May 19th expiration. Hold on a second here. April. There we go. I was looking at the wrong one. I'm looking at about 90 days out. That's about what I wanted. April 21st. And I am going to get a long 27 strike call. Now, quick little look at this. If I were to just buy this as a call, it cost me 93 cents. Now, in theory, if VXX shoots way up and goes past 27, this could go up quite a bit. But the cost of it is very, very high, and it's also going to be exposed to a ton of theta erosion. Very, very rapid theta erosion. Well, over its life, it's going to basically erode down to zero if VXX doesn't shoot up over this. We need to make this a little bit better. We need to also, reduce our cost dramatically, control the trade a little bit. So I do something else. In this case, I'm giving you a rule of thumb, but once again, I hate those. I am going about $3 out, and I'm going short. Now, that changed the trade a lot. Our cost went from 93 down to 24. The max, but there's a trade-off. The max I can make out of this is $3, the difference in my two strikes. And out of that max profit, I've got a 24-cent debit that's going against that. So let's run a little bit of a calculation here. Not a big one. $3 minus 24 cents, $2.76. That is the max profit I can make on this, and it's costing me 24 cents to do it. That means that for every $1 I put into this trade, the max profit I can get on this is $11.50. That's 1,150% return. To get that though, let's be real, we have to have VXX jump up a lot. It'll jump up from where it is now, 19, to probably a bit past 27. I'll show you that curve in just a second. Now, this number becomes very, very valuable to me. Because remember, a second ago I figured out how much I'm protecting in the market, how much I'm protecting in my portfolio. Now, just from long years of trading, I know that we need to do a bit of a reality check here. We are not going to make 11.5 times the money that we put into this trade. Practically, I just do a swag adjustment of this and say that I'm going to make about 80% of this. So times 0.8. My real adjusted leverage factor on this is 9.2. Great. So if I am going to protect $8,000 worth of portfolio from a catastrophic market bad day, I just do $8,000 divided by 9.2. I need to spend $869 on this set of contracts to do that. Okay, so if this contract is 24 bucks, I would buy 36 of them. All right, so that's it. My trade is 36 of these. Set it up, buy it. I have spent $860 some odd dollars, and I have created a trade that when and if the market goes into a major correction, implied volatility shoots way up, and that causes VXX to go past my strikes. I'll show you the P&L curve in a second, and allows me to walk away with somewhere around an $8,000 profit. Now, once again, we got to always deal with reality. It's a pain in the butt, but it does kind of intrude on what we're doing. Reality is that as time passes, the nature of this trade changes. Later in the trade, this trade is actually the most effective when it's close to expiration, and it's least effective when it's just put on. By the way, I need to toss out some thanks on this. This idea actually came from one of the people in my trading group, my ALTV group. They thought, hey, if we're going to do this, why don't we just do half of the trade and leapfrog it? So what we're doing is we're putting on half of our hedge with one expiration, letting a little time pass, and putting the other half of the hedge on. And as one of those falls off, we just go in and put another one on, and another one, and it blends this to give us a good overall protection. It wasn't my idea. Actually, it was a great idea from one of the people in the group. So in this case, I'm actually going to drop this down to about 18 contracts, and I'm going to add this in. And let's do a really quick analysis. Wait a second. By the way, I've got a bunch of these on. These are not theoretical for me. These are real. There. This is the trade. Now, a couple things to remember in this. VXX options are a little bit weird. They're actually pre-pricing in a well-known price erosion effect. So one of the reasons we can get into this trade so cheap is that it is partially priced in there. So that's kind of part of the game. If volatility shoots up, what happens to VXX? Well, VXX goes up also, but it's not necessarily a one-to-one match. As a matter of fact, here, let me show you a quick little kind of cool thing. This is, you see the curve right here? And remember, VXX is built from this futures contract and this futures contract. When things go really, really crazy, this curve ends up looking like this. Short term goes super, super high. A little bit longer term goes very high, but not nearly as much. VXX ends up being a blend of these. So you're never going to get a perfect one-to-one relationship between VIX and VXX, but it's still pretty darn good. And by the way, there's a massive problem using VIX options on this. What you don't realize, or what most people don't realize, is VIX options are not on the VIX. They are not trading the VIX. VIX options are trading these futures, and the pricing on these futures is different depending on the expiration. So you don't avoid this problem by trading VIX options. You actually make the problem worse. That's why we're using VXX. So market does its correction, boom, we have VXX jump up. Now, if this, remember this is only half of our hedging, if we had VXX jump up quite a bit early, you'll notice the slope is a little shallow. Early in the trade, we don't get as much protection. Later in the trade, our protection is actually improving. Notice how the slope of that line as time passes is getting steeper and steeper and steeper and steeper. So it's going to take less of a movement to make a big payout on this. Now, we did that on purpose, and we're actually overlaying that with another trade that I've already got in here, which is the other half of our hedge. So we just blend those two together, and it gives us pretty consistent coverage over a longer period of time. In this case, we are spending, let me see here, 18 times 25. Let's see, 25 times 18, 450 bucks. So let's say we spent 850, 900 bucks grand total on this to give us on average 3 months worth of protection. We spent 800 bucks to protect a $100,000 portfolio against a fairly major market crash for 3 months. Now, is it worth it? Well, I know personally that I can now focus on trades to make me way more money than that on my $100,000 portfolio that I probably would have gotten freaked out of and walked away from before. So yeah, this allows me, this gives me the confidence to take trades that I might not take otherwise and focus on what matters the most, which is what is actually happening in the market. You have to put a little effort into this, but you actually train yourself to filter out that risk. You don't forget that there may be a correction, but you don't allow yourself to use that in your analysis of the trades, because if the correction happens, the hedge does its job. So let's walk through that. In fact, I'm going to fire this off right now. And I just got to fill on it. Great, nice and easy. By the way, VXX options are great. They fill really fast. Okay. What happens when the proverbial manure hits the fan? This is your game plan. Okay, and once again, this trade is not about making a profit. It is about protecting you and letting you make profits in other ways. The market goes into correction. When, as I said before, the first couple of days you are not going to know it's a correction. And suddenly everything's going to be going really bad, implied volatility shooting up, you're scrambling to close out trades, you are losing money. Your number one focus at that moment in time is this: close your risky positions. Flat out. I don't want you to focus on anything else. In fact, prioritize your trades by risk. What are the ones that are failing the fastest, and what are the ones that are hurting you the most? Close them. Close them quickly. Next, you've got lower risk trades. Some of them might even be good profitable trades. If you get some long volatility trades in there, those are going to be helping you out, balancing off your portfolio. If you've got bearish trades in there, those could be making some great money. Make some decisions, clean up your portfolio, and get it to a point where you are very comfortable that no matter what craziness happens, it's in good shape. Now, once you've done your job, once you've done that part of everything, then jump over to the VXX trade and close it and take your profit. On the first trades that are failing, you're going to lose money. The VXX trade at that moment should be making you a pretty decent profit. Now, is it some variability? Is it going to cover you exactly 8,000, 7,000, over all of the VXX trades? It will vary depending on, how high IV goes and what the timing is. But it should get you something in that range. So, do I want to walk away from that correction with a 10, 15% loss in my portfolio, or do I want to walk away from that correction with a 2, 3% loss in my portfolio? Me, I tend towards the smaller failure. I would much rather have the smaller failure. So hopefully, and by the way, whether you join up here or not, we've got a bunch of people who've joined, loving it, looking forward to seeing everybody. Whether or not you join up here, whether or not you even become an active options trader, remember that one little trick that I just showed you right there. And this will be on the recording. That can be used against a whole ton of different problems. It can be used against 401ks failing. It can be used against your basic stock investments. It can be used against a bunch of things. It is a general market correction hedge. It's cheap, it's effective, it does a good job. Just don't come to me when it loses money, because that means it worked for you. So there we go. All right. Let me send this out to my group. In fact, I'll send it out to everybody, I believe. And that's it. Why not sell May 30 calls instead of April's? Here's the deal. The further out in time you get a little bit cheaper of a trade, but you're going to be in that position for a longer period of time, and VXX is going to erode more. You know, the prices do account for the erosion a little bit, but it doesn't perfectly account for it. And over time, you know, as you get way, way out there, the trade is going to, VXX is potentially going to get further and further away, and that can cause some problems. The other thing is this, the trade is most effective and works the best as a hedge when you are closer to the expiration. The last 30 days of that hedge actually is a more effective hedge than the first 60 days. Now, every day you move closer. So if I go further out in time, I've got a greater period of time when I'm just not, it's not as effective. I'm even considering at this point taking that leapfrog approach and even going one step beyond that. The reason we do the leapfrog approach, where we're doing half of our hedge with one expiration and then another expiration, is it lets us get the lower expense. It's cheaper for your per day coverage. Your insurance costs less on a daily basis if you go further out, but your coverage is worse. The leapfrog allows us to kind of average this out a bit. We're taking half of it here, which is further out, and another portion of it is closer in. I'm almost to the point where I'm going to break it down in thirds and just every single month do the same thing. And, you know, 1/3 of it is out 90 days, you know, 1/3 is out 60 days, 1/3 is out 30 days. When the first one expires, I put the new one on, and I just keep rolling it. Keeps it a good, consistent coverage for your portfolio, and still maintains the ability to get the cheaper cost by using the longer terms. There are always trade-offs there, though. Just understand that there's no perfect answer to this. We're trying to get the best we can get. It's like buying insurance. Has anybody ever worked through those forms trying to figure out exactly what coverage you're getting? It's kind of the same thing. You know, you need to put some effort into figuring out a way to minimize your costs but cover you the way you need. So there you go. Let me fire this off. Ray, if the earnings moves out of the 15th, 20th of Feb, can we roll it out to take advantage of the increasing IV? Ray, I think that at that point our best bet would be to close that trade. If it was a cycle, that may be an opportunity, but my guess is the IV would almost instantly shift into those, and we wouldn't have the chance for the IV to increase. So on that PCLN trade, it probably going to do quite what you want to do. We will have other opportunities, though. Knock on wood, we'll have some good ones there. You know, like I said before, we don't win every one.
Hey, Doug, as you're, can you hear me?
Yeah. Yes, I can.
Okay, good. Doug's going to fire that stuff off, which gives me airtime. Folks, Doug's going to wrap up here. Why? Because the commanding officer's here. And as Doug does on every full throttle, he over-delivers, folks. So for all the people still and saying thanks, Jay, Ray, all you guys saying thank you to Doug, he's going to fire this off and he's going to wrap up because we need to get to work. Doug's got other portfolios. He's got an advanced trade alert to send out later this afternoon sometime. And I got 4 portfolios I got to manage for our current members and our 49 or however many new full throttle members. Okay, so folks, you got to get, this is genius. There you go. The word Doug and genius in the same sentence is a little vomiting to me, to be honest with you, Doug. And a great job in all caps by John. Hey guys, his head doesn't need to be any bigger, folks. We got to get going. I'll let Doug fire his trade and wrap up the trades. But you got to get to the somebody just asked for the replay page. I'll put the replay page in here. Doug's replay will be up here in a little bit. I think since I started recording it, Doug, I got to be the one to render it and do all that crap. So I will do that for you, Doug. You owe me a shot.
Good, because I'm not going to miss that part.
Exactly. That's the part that sucks. And we're going to get airborne, folks. We're almost done. I know I see Annie's line has been almost busy all morning, folks. So if you are just sitting here saying, okay, great, I guess I'll grab my slot now. I don't know even if we have any more. So Doug's going to wrap up here. He'll send out an advanced trade alert. He'll send this stuff out in a nice professional email, like he said. There's the flow of events, folks. Text alert. As soon as Doug and I, you saw me do it the past couple days, as soon as you see Doug and I enter a trade, we go right over to the broadcaster. We fire it out. About 10 to 15 minutes after the webinar. Why? Because we need to hit the head and get a drink of water. We'll come back, sit down, and fire out the email. And then as we're firing out the email, in the background, the video's rendering from the replay, and about an hour later, we'll get the replay up. So text alert immediate, email 10 to 15, 30 minutes after the webinar, and then you get the replay, folks. We're some of the only guys in the industry doing this, okay? And I know we're getting a lot of kind words right now, but we're going to be closing our doors here shortly. So, Doug, I'll get out of your way real quickly. I'll wrap up after your wrap up, Doug, and we'll get airborne, okay?
Well, I'm pretty well finished with what we've got for today. Yeah, I'm sorry about this. You know, when I get going on this, I do really enjoy doing this stuff. It's fun for me. I really like working with people. I like answering the questions. I feel bad today, bluntly, I know I missed a bunch of questions. They're literally streaming by. I'm sorry about that. In a normal session, you don't get that. We've got a much better system. Go to training does a much better job, and we take a lot of time to make sure the questions are answered.
You bet.
You know, it's 2 hours, 40 minutes in. Yeah, I went along quite a bit, but
that's why
always a replay, and you can always break away if you want.
that's why I showed up, man. Provide you mutual support, because folks, I would have sat down at dinner time tonight, and Doug would still be training you guys. So you're getting a hell of a. This was all free, by the way. So, Reg, thank you guys both for serving. On behalf of Doug, I know it was an honor for both of us to serve. Harry, this was a short class for Doug. Ooh, so I need to come in here more often and boot him out of here. We need a live full throttle in Bozeman. Sailor Rob, if that's Montana, man, you can kiss our ass. I'm not going to. Maybe in.
Oh no! Wait a second here. Wait a second. Bozeman, hell yes. Okay, you need to talk to me, and I will definitely show up because you. Let's see, you got Big Sky, and I will get my snowboard out, and we will absolutely go hit that.
I flew out of. Was it Great Falls? Whatever. I fought the F-16 guys out of there, man, but it was in July, and I think it was still a little cold. But I'm just kidding. We'd love to. Harry, thanks, Doug. You delivered like always, picking up more and more each time. Thanks, TGO. Sailor Rob, you guys are awesome. Thank you. Hoorah. Cheers to both. Thank you so much. Muli Gratis. Mila. Great stuff, guys. Looking forward to your training and working with you. Steve. Kavan, I don't know Skip's schedule. He's Kavan, if you're talking to Skip offline, you guys can do it. Signing off. Love you both. Thanks, Harry. Doug uses spatial intelligence. You know what, Doug? When I woke up this morning, there was no way on God's green earth I would have thought I would have seen the two words spatial intelligence together with Doug a word away from that. But
no, actually, I actually think that's a pretty good description of it. I mean, visualize what's going on.
Yeah.
I can kind of see how everything works in kind of a spatial, geographic way, or geometric way. Excuse me. Wow. But yeah, I'd say that's a pretty good description of what I look at things.
There you go.
You know, how I look at things. Hey, by the way, I'm sorry to whiz. I just want to jump in real quick. And by the way, this is completely this is me being selfish here, but I just want to stick something in your head. We have another program, and I'm going to be blunt, it has nothing to do with what we're promoting now. This is not even something we're starting up next week, but in 3 to 4 weeks-ish, we're going to be doing a program that we call Wingman Group Coaching. And it's my program, it's my baby, I like it. It is not like this. We take a very small group of people and do a lot of work with them. I keep it small. I think the current one is about 8 people. And it is a chance for people who really want to go further and be very, very active in this to get in a small group and work together on trades and trade ideas and basically build out a portfolio and portfolio trading style that can be really good. Now, I'm saying this is selfish because this has nothing to do with this promotion. We only promote this to people who are already internal and members of Full Throttle. When the time comes, we'll send out some information, but there. Okay. Thank you for putting up with my, giving me the chance to say that, because I'm looking forward to having a new group of that sometime in the future here.
That's a great point, Doug. And folks, you can't, if you're like, wow, I like that, you can't get into Doug's kind of mini hedge fund called Wingman Group Coaching unless you get on board full throttle. And since it's Doug's one-on-one time and you're with some, you're actually going to become good friends with the folks in your Wingman Group Coaching group. It's more expensive than the full throttle course, but it is worth it. You will leave that as like a mini hedge fund manager, man. Doug takes you through different roles. Hey, one week you're the risk manager, 1 week you're the portfolio manager, 1 week you're the idea generator. So we'll talk about Wingman Group Coaching. It's actually after Doug's 4 or 5 weeks of full throttle training. As you can see on my screen, or hopefully my screen, this is Doug's training schedule. And last night you got a sample training of his vertical spread class, which is right there, session 4. He does what he did last night for iron condors, calendars, exits, adjustments, the Greeks. You're going to get all this stuff, folks. And like I said, Doug and I will give this to you as long as you're a member of Top Gun Options in good standing for the next 2, 3, 5, 7 years. You will always get invited back to Doug's training whenever he does a full throttle, and that's $495 right there, folks. And I should put that on this page right here. Like, hey, and by the way, you get to attend all Doug's full throttles going forward on us, and that's $495. So Stan, I think you said, hey, great training, seriously considering getting on with you guys. I got to be honest with you, Stan, if you're still seriously considering, you're probably not going to have a slot, because I know Annie's on the phone. My phone just buzzed twice while I was yammering here, which means probably 2 more slots went because people wanted to see Doug. They saw him train last night, and now you saw him do it live in the market. So we're going to be probably filled up by lunchtime, or maybe after a couple people watch Doug's replay here or get his email. So folks, we're not kidding. We get 50, this page comes down, and we're going to be done. If we don't get 50, well, make sure you join me tomorrow anyway, and Doug, for about 20 minutes. I'm going to do a weekly options brief tomorrow. If you have no idea what the hell a weekly option is, come tomorrow. Even if you don't, you guys are both, you both suck, but I want to know what weekly options are. Come tomorrow, even if you're not going to sign up for full throttle, because I'm going to teach you a little bit about weekly options and put a trade on. How many of you, well, only the members did, since I didn't give it to the free people. How many of you made $1,600 in a day, a Monday, Tuesday? How many of you actually are up right now on the Amazon trade, $1,000 or $1,100? Where's the Amazon trade? How many of you, give me a hell yeah if, so here's the SPX trade I sent out on Monday, folks. It was $1.05. I sent this alert out on Monday for $1.05. Can anybody tell me what it's trading at right now? 0. What is 15 times that? My members made $1,500 on this SPX trade between Monday and now. How about it? What's Amazon doing? And of course, I didn't get filled. Amazon, I sent the trade alert out at 95 cents. It's at 60. Let's see. All right, let's do some Navy math here. And what's that? 35 cents. 35 cents times what did I do? 30 contracts equals 1050. How many of you made over $1,000 on my Amazon trade? Let me look. Hell yeah. Thanks, Wiz. JP, Marion, been a killer start to the year already. Yep, 10 contracts. Dwight, I'm up $300. Thanks. You're welcome. Jim, didn't get filled. Darn it. Jim, I'll use worse language since I'm wearing my sailor suit. Damn it. I didn't get filled. Remember, folks, this is a market. Doug and I, there are some times when Doug's like, hey, I got filled, and half of you are like, well, I didn't get filled yet. It's a market, man. If Doug and I were on the floor and standing next to each other, there's the market maker in the middle. He might fill Doug, and maybe because the guy didn't like my tie that day. It's a market. So remember, sometimes we may not get filled, and you get filled. Here's a perfect example this week. I didn't get filled on either of those, and my members did, and they made, we're up over $4,000 on the trades. How about the Goldman Sachs long call diagonal with a protective put? I did get filled on that. How's that looking? Who's up $225? Hey, that's a nice bottle of wine tonight on the Goldman Sachs trade. Here's the Goldman Sachs trade I put on a month ago. It's up $6,600 in a month, and I'm not going to bore you with all the Goldman Sachs winnings of our current members. You saw Chuck last night, who's up $111,000. He traded 20 contracts, folks. I did 5. That's Chuck. Diane up about 50 grand. Scotty's up about 45 grand. They did the September and October Goldman Sachs trades, guys. So Doug and I opened the doors to our squadron this week, and you can see that we're doing it live. This ain't made up. This ain't bullshit. You need to get you. We need to get you guys airborne. So let me just throw a couple slides up, and we'll be done here. So, well, there's the business end. There's my trading cockpit, or it wasn't a trading cockpit. There was my real cockpit. And you see that red button right there, and then my finger on the trigger? That's called the Deliver Justice button. But anyway, here we go. I don't even know how many slots we have left, or if we do. Like I said, we're not taking more than 50. I already talked about, oh, that's right. On Tuesday, I closed the Apple Iron Condor I put on last week for about $2,500. A couple of you just texted or wrote in the chat box, hey, Wiz, don't forget Apple. Some of you made a max profit of about $3,300. My members did in a week, 7 trading days. I put it on in last week's primary live trade brief. 5 trading days. The S&P 500 trade I put out on Monday to my members is up about $1,600. The Amazon trade's up about $1,100 in 2 days. Folks, we did this in front of you, and if you hold the Amazon trade, somebody asked about 5 minutes ago, Wiz, would you hold it? Right now, using at-the-money volatility, that number is wrong. It's not a 69% probability of making $2,900. I think when Doug was talking, it's at about a 78% probability of making $2,900 in 2 weeks. That, folks, I've more than, not even talking about Doug's trades, I have more than paid for about 2 years of a full throttle max membership. There was not one losing trade this week. Now, somebody type it before I say it. Yes, there was, but it wasn't a losing trade. I sat here, hopefully you guys, or Doug was busy, hopefully you saw me smiling. Did everybody hear what Doug said? He said the same things I said. When I put on a VXX, I'll say position. Position, it ain't a trade. When I place a trade, I want to make money. When I place a hedge, I don't give a shit. Here's what I mean. Like Doug said, it helps me sleep at night. I never lose money on a hedge. Well, Wiz, the VXX trade's down $700 since Tuesday. No, it ain't. Yeah, it is. No, it isn't. Not to me, folks. I never got airborne in the Hornet and said, this stupid ejection seat, hey, Chief, take it out. I want an extra 800 pounds of gas. Well, sir, aren't you going to, you might get shot down on this mission. No, I'm not. I'm awesome. That's stupid. Don't trade that way. So if you're sitting there going, well, I lost a couple $100 this week on my VXX trade, you're not going to get along with Doug and I here at TGO, period. You probably need to go somewhere else. And like I said, the Goldman Sachs trade's up about $200. Whatever, you guys know how my portfolios did 2016. Triple-digit returns, crushed it. Here's all the Goldman Sachs crap. Just look at the top left comments here and the top, or the bottom left here. There's it's Mike. Sorry, I got Chuck and Mike reversed. Mike's up 111 grand on the Goldman Sachs trade since September. Because down here, as you can see, Mike said he did 20 contracts. Chuck, he's up 16 grand in 2 months, and he did 3 contracts. And over here, I have my idiot trade. I'm up 6 grand because September, October, November, I didn't want to pay full price for that Goldman Sachs muffler. And who's the jerk now? Me. I put mine on. I'm like, I will pay full price for this muffler. Goldman Sachs is going up 6 grand in a month. So I'm actually chasing my members' performance, which I will gladly do anyway. So guys, now it's time to choose. Here's the normal flight schedule for us. I do Monday weekly options at 1 o'clock. I do the PLTB Tuesday at 10 a.m. I do accelerated retirement at 1, a little bit more conservative portfolio where I did that Facebook synthetic covered call with a protective put. And then I send out an urgent alert whenever I see a good trade for the week. It's one of our lower price services, but we throw it in there just like Doug's advanced trade alert. Why? Because we throw it in there and it's a value add. Doug does his advanced live trade brief. You're in it. And he also does his advanced trade alert. He's usually a Thursday guy. He's usually got 2 good trades, maybe 3 good trades in his pocket, plus adjustments to existing positions. So Thursday's usually Doug's days, but sometimes, you know, I'm sitting in a hedge fund meeting down in Miami. My phone buzzes. You know, there's a Doug alert on a Monday. Whenever he sees a good trade, he sends out an advanced trade alert. And as he foreshadowed, I think we're going to do it quarterly, Doug. The Wingman Group Coaching Program. You actually have to apply for it, folks. It ain't, hey, here's my money, me. Doug will do maybe a 30-minute to an hour-long call with you to see where you're at and if you'll fit into the Wingman Group Coaching. And if you do, like I told you last night, we have a couple registered investment advisors and managers in there who Doug's teaching. And we have normal folks like Doug and I were before we came here. We have regular old retail traders in there who are really taking their game up a notch. Okay, so Wingman Group Coaching you'll hear about down the road. Here's how it works. We got the aggressive track, the conservative track, and both. The offensive track is everything we do, and you get weekly options, okay? That's the offensive track. That's you shooting an Air Force guy in your F-18. The defensive track is, you know what, maybe I'm not a weekly options guy or gal just yet. Let me try accelerated retirement for a little bit. You can always upgrade, folks. That'll be you flying an accelerated retirement with your 600-mile radar out there looking out to January of 2019 like we did with the Facebook trade. Or you can be this guy or gal, max afterburner, everything we do here at Top Gun Options, except obviously the Wingman Group Coaching or the Commanding Officers Club Coaching, which is just one-on-one with Doug and I, very, very high dollar. And, you can email me if you want some one-on-one coaching with Doug or I. That's it, folks. That's the max afterburner. That's you. A couple folks throughout the week said, hey, Wiz, I work for a living. In our 2015 customer survey, our member survey, 80% of you, it was a little bit more than that, I rounded down, work. Folks, you got Doug's text alerts when he placed them. I have my Options House platform on my phone. I've actually gotten some of Doug's trades and gone, hey, that looks like a good one, and I've placed it. So you could be sitting at work in your cubicle, don't mind me, boss. You don't have to be here for the live trading, but guess what? Lunchtime, kids go to bed, watching the Falcons beat up the Patriots. You can sit here and watch the replays whenever you want to, okay? So, and look at what Chris said. Hey, man, I'm so geeked. Been a subscriber for almost 3 years now, and this is the first time I've been able to attend live. 3 years, Chris was a member. I only know you via the replays. I guess he had an off day that day. So don't worry. If you work, you can do Top Gun Options. And just to make you an offer, you can't refuse. We throw in our manuals, the primary, intermediate, advanced, sitting on the couch, sitting on the airplane, flying somewhere, go through the manuals. Hey, Doug covered a calendar today. I'd like to brush up a little bit on the calendar trade. Read a chapter on the calendar, man. We throw that in there. You all got the Options Pocket checklist when you opted in to the webinar, so you already should have a copy of that. Let's get airborne. And what's the catch? There is no catch. The only catch, folks, is the slots. And this slide's wrong. I didn't have time to fix it because I was at career day. Why do we keep it small? Doug hit it. I'm going to hit it again. Folks, we can't have a room with 1,000 people. Doug and I, we can see your chats going by. Every question that goes by that he or I don't answer, it makes our skin crawl as instructors because that's somebody that needs help. And if I don't answer that, I feel like shit. And I am going to say that, and I apologize to the lady who the other day said, watch your mouth because my kids are running around. That's how I feel, man. So we keep it tight. We keep it small so nobody leaves. And this is why Doug does a long session. Nobody leaves without their questions getting answered. Okay? So, man, that's almost a 3-hour session. We're going to end in about 2 or 3 minutes right on the top of the dot here. If you need to call, which I don't know why you would have to, there's our number, 754-300-1084. Annie Santos is our Director of Client Services there. Or you can email her, support@topgunoptions.com. Once you become a member, you can talk to Doug and I whenever you want in a place called the Ready Room. Let me just show you real quick the Ready Room on the website because we don't have any live trade briefs on Fridays. We do tomorrow since I want to do weekly options. So in the Ready Room is like the living room of a fighter squadron. You get to interact with your, the senior pilots, the junior pilots. I didn't learn how to fly the Hornet from a book. I learned how to fly and fight the Hornet in the Ready Room, man. So in the Ready Room, you can speak to Doug and I. So if you grab your membership now and you have a question, get in the Ready Room, ask us. I mean, Doug and I aren't there like instantaneously, but within an hour, 50 minutes, or that, it will be answered that day. See, hey, what are some of the topics here? The Priceline trade, Doug, IBM earnings trade, JP Morgan, hey, Wiz, managing long call butterfly. Everything's in here, folks, and you can see that Doug and I get in here and interact. Okay, so that's about it, guys. Again, here's the page with everything you need on it. Go.topgunoptions.com/FT full throttle dash now. So it really is full throttle dash now. Okay, let me just scroll up through here. And Doug, you can split, man. I know you have work to do. I'll wrap up for you, buddy, because I know you need to crank, and it is noon. Pat's Crush Falcons. Yeah, go ahead, Doug.
One thing real quick. Hey, everybody, appreciate you all showing up today. Thank you very much. Wish I could have got to the questions a little better, but you've all been a great group, so I appreciate that. I will hopefully be seeing you in my sessions shortly, and have a good day. Make some good trades out there.
Awesome. Thanks, Doug. And another one who is Rita Longino from New Mexico. Corrales, New Mexico. Love New Mexico, so welcome aboard. Folks, they're going. Kavan, best money I've ever spent. Thanks, Kavan. Kavan's a member, obviously. Does Doug's trades/training go with the defensive program? Yes, Stan. If you look over here, Stan, under the defensive, here's Doug. Anywhere you see the word advanced, that's Doug. And then obviously you get down here, Doug's training. Doug teaches all this stuff, man. And I actually, like I told you last night, I sneak in every once in a while because I pick up some stuff from Doug every once in a while. Don't tell him that. Britain took all their personal armor out of their bombs and lost. Yeah, I know, Mark. Okay, good. Steve, welcome aboard. Thank you. Steve, Full Throttle Max member. I am with you in Goldman Sachs. Patrick, good. And you're up $500. All right, Patrick, maybe you did 10 contracts. Wait, can you guys still hear me? I'm getting a thing that says audio lost. Can you guys hear me? Can you guys hear me? Can you guys hear me now? Can you hear me now? Okay, good. Guys, I got to go. I mean, literally, I'm sweating in this thing, and Doug and I have to work. We're almost out of slots. We'll still do the weekly options presentation tomorrow afternoon. I will have a special announcement tomorrow afternoon after the weekly options brief if we still have 1 or 2 slots left, okay? So have a great rest of your day. Happy hunting. Make sure you hedge. I will render this video, and I will put it up on this page right here along with every other video. If you just, I know there's actually one of our strategic partners emailed his list last night. So I know there's some of you who literally this is your first webinar. You have to go to this page and spend, please, a couple hours just watching all the previous replays so you get a sense for what we do here, okay? All right, guys, have a great rest of your day. God bless. Happy hunting. Make sure you hedge. Welcome aboard to all of our new members, and then I'll see you tomorrow afternoon at 1 o'clock for our final full throttle session, and then Monday morning we're airborne without the 3,950 people who don't grab a slot. Okay, guys, I got to shoot my sit rep, and I'll talk to you guys tomorrow. God bless. We'll see you.